right now, I think the labor market's holding up fairly well. You're going to see the labor market showing us an easing of tightness.
We need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market.
The labor market is also getting into better balance in terms of supply and demand.
We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. One more stop, the Payrolls report, 8:30 Eastern Time, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500 positive by 1/3%. The 3-month average on payrolls, 276K. The estimate this morning for April, 240. Jefferies has the high at 280. Goldman, Bramo, not far behind, 275.
And what's the distance between having a stagflationary narrative and something that's similar to Goldilocks? To me, that's going to be the key question. Yes, Michael Hartnett really laid this out from Bank of America. But to me, what's the difference in terms of how big the change has to be in the number for people to either be talking about gloom and doom or, oh my God, everything's perfect?
Michael Hartnett really put the lines in the sand this morning. 125,000, if that comes in, 125,000 jobs. He said that will be stagflation, risk off print. But if it's north or at 225, Goldilocks back on, risk on.
Just don't say stagflation to Chairman Powell in a news conference because he does not entertain that kind of word. Right now, I'm looking at Apple as well. We need to talk about this. We're up by almost 6% in the pre-market. So Apple, sales decline less than feared. Let's not even talk about the product. Let's talk about the financial engineering. The biggest stock buyback ever. An additional $110 billion. And Lisa, if you take the top 5 biggest stock buybacks ever in the history of US markets, it's Apple, 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 Apple.
This is going to be the question increasingly among so many people. Is this still a growth stock or is this a value stock? Is this a stock that has so much money, and this is a company that has so much money that the best thing that it can do with it is just give it back? And that's really going to be a key question of how you value some of these names that have become more established than their upstart really beginning.
It's a massive buyback when it comes to the cash, but it's only 4% of Apple's total market capital. And you talk about whether or not it's a growth stock or not. Richard Windsor this morning, he calls it fat middle age versus fighting for survival. And basically what this report just shows is they're stabilizing and there's no growth.
Are we calling Tim Cook fat middle age?
Yeah.
Is that what just
Not
happened
Tim
there?
Cook, the company.
Yes.
Let's be
just
careful
to clarify.
here.
All right, just to clarify, more Southside reaction. Morgan Stanley going to get in trouble here. Alleviated concerns about China. Evercore, a notable improvement in China. JP Morgan, better than feared launchpad into the AI upgrade cycle. This is what it's about. What do they unveil in September? Is that going to be the carrot over this stock for the next 6 months?
And how low have the expectations been set? I mean, honestly, how much has this earnings season been entirely a measure of how much was baked into the stock price rather than what they actually delivered? They still didn't deliver any kind of gain. They expect a sales gain, yes, but you don't necessarily see this potential for gangbusters growth in China, the most competitive market in the world, talking about how they're going to have to try to compete. It just is an interesting moment in terms of a redefinition of a company that used to be absolutely skies away, fighting for your life.
China's a bit of a mystery, and we'll talk about China in just a moment with our guests. Equity futures right now on the S&P positive by 0.4%. The scores look like this morning going into payrolls. Yields are lower by a single basis point on a 10-year, 456.71. Coming up on this program, Chris Ferro of Strategas as big tech sends stocks higher. Pierre Ferragu of New Street on Apple's record-breaking buyback plan, and Sarah House of Wells Fargo with the payrolls report on deck. We begin with our top story. Big tech lifting stocks ahead of the payrolls report. Chris Ferro of Strategas, a Baird company, saying this: at a minimum, be more discriminating as to what you own here and use any oversold rallies to reduce exposure to clear laggards, as that list is starting to grow even longer. Chris is with us around the table. Chris, good morning to you.
Great to be here.
Before we get to payrolls, let's start with Apple. What can we take away from Apple this morning?
I think where the stock opens today is going to be a really big level. It really broke down from about 185, 190 late last year, early this year, and we clearly will bounce there and open about there this morning. I would probably be more inclined to be a seller of that move, or at least take some chips off the table. This was not a good trend going into these numbers. We're always skeptical of things rallying in downtrends, and I think Apple certainly fits that description. I would also put Microsoft in that camp, to be fair.
Interesting.
This is a stock that people talk about as a leader. They behave as it's a leader. Microsoft has not made a new relative high versus the S&P since November. It doesn't feel like that, but that's the fact. And in fact, this week it made 6-month relative lows versus the S&P. So there's this subtle, I think leadership change that's been with us for the last couple months, I think it's become more overt over recent weeks. And listen, these tech stocks are oversold. I suspect they can bounce, but what do you do on these bounces? I think you want to reduce your exposure there.
Well, let's take a snapshot of how you measure some of that. So you'd look at, say, the equal weight on the S&P 500 versus the Qs. What does that tell you right now, just the relative performance?
Yeah, that's starting to actually flash some life here. And, the narrative has been that a lot of these tech earnings have been exceptional. You saw it with Google, you saw it with Microsoft. But if you look at equal weight S&P versus triple Qs, or even anything versus triple Qs, K-Web versus triple Qs, you're starting to actually see, I think when people would least expect it, in this corrective phase, you're starting to see some type of a subtle shift there. And, in particular, John, if you look at equally weighted tech, that broke about a 15-month relative performance uptrend over the last few weeks. So I just want to be aware of that. And this is not an outright call to be a seller of tech. It's a call to be more discriminatory. This was really easy in tech for the last year and a half. I think it gets harder from here.
So let's talk about the why.
Yeah.
I was reading your note yesterday and I was thinking, how does this make sense given the fact that people expect rates to remain higher for longer and that maybe that's going to hit some of the smaller or consumer-facing companies disproportionately? From a theoretical point of view, I know you're a technical analyst.
Yeah.
How does this make sense?
I might politely disagree on the higher for longer here. I think it's become this, you get such a clue into where the consensus is just with the emails you hear every day, what's talked about on financial media, all the like. And I've just heard stagflation and higher for longer every day for the last 3 or 4 weeks. And bond yields have quietly kind of stalled out here. Right? Coming into this week, yields were very overbought. I think you've begun to see some subtle clues that yields don't run away from us. The turn in utilities, right? It's always a message when you have utilities moving with bond yields higher. I've seen that a few times in our career. It has generally meant that the move in yields is closer to ending than beginning. I think the strength you've seen in financials throughout this entire correction, one of the unappreciated things of this entire last 5-6 weeks, banks have acted great. If yields were really going to get away from us, is that what we would expect? At the same time, you're beginning to see some faltering in the relative performance of tech. I at least want to be open to the idea that we're closer to the end of the move in yields than we are at the beginning. And I almost feel like a pariah even suggesting that because I think everyone's at 5 or 5.25.
I guess I'm trying to understand how this narrative has shifted. Because last year it was that rate hikes are going to disproportionately affect tech. That the higher the rates go, the worse for tech. If rates go down, that will actually give a boost to tech because of the valuations and where they're at. Now it's the opposite.
I'm always skeptical of narrative creep or when narratives change to kind of fit the price action. I think you've certainly seen it with that respect on how yields respond with tech. Where I've seen it recently is this idea that utilities are improving because they're an AI play. That's just silly to me. Right, you've heard so much, own utilities because the power demands. That sounds like narrative creep. Maybe own utilities because there's a counter-cyclical streak running through markets globally right now. That seems to make a lot more sense. So I think, Lisa, be careful when you start to get these little pockets of narrative creep. I think the rate tech one is one of those, and maybe the utility AI story is another. If you want to own AI, just own AI. Don't own utilities.
Okay, so I can keep going with narrative creep, and you can keep sort of shutting me down. But another part of this is that if the Fed's going to be cutting rates, it's in the face of weakness. Today's a great example of that. If we get a number in the jobs print that comes in substantially lower than expected, this makes rate cuts more likely on the table. But why would you want to broaden out into more exposed stocks if that means that the consumer is weakening?
It's funny. I think the market's perception of whether the economy or the consumer is weakening or strengthening, I'll take that opinion over mine any day of the week. And I want to look at things like industrials versus utilities or discretionary versus staples to really get an understanding if the market perceives the economy and the consumer to be weakening. We've seen some modest softness there over the last 5 or 6 weeks, but it's within the context of the uptrend. And, I think this kind of begs a broader point. Do I really want the entire call to hinge on whether payrolls are 125 or 175 or 250 today? I think at the end of the day, we went into this corrective phase in mid to late March in a fully confirmed bull market. The new high list was expanding, the breadth was pretty good, and I think you have to give markets the benefit of the doubt here, irrespective of what the data looks like over the next 5, 6, 7, 8 weeks. We had an oversold condition develop over the last couple of weeks. I think there's been changes to sentiment. This obsession with stagflation, this obsession with weaker growth has served to chip away at probably some of the bullish sentiment that was out there.
When this number drops at 8:30 Eastern time, we'll go through equities, then bonds, and I'll turn straight to foreign exchange and dollar yen. It's 7 p.m. in Tokyo. What are we looking for from authorities in Japan off the back of this number? Is that the first look for you? What's happening in foreign exchange?
Well, what a move in yen this week.
That's ridiculous.
I mean, career type move in yen this week. We have found the BOJ's limit. I think 160 and change is the BOJ's limit. We're back to 153 and change this morning. In the spirit of what puts a top on yields here, what puts a cap on yields, I think that's another thing. I mean, dollar yen has been so closely correlated to bond yields, and the fact that you're seeing some type of a shift there. Now, in the face of record yen shorts, I know you guys have shown the data, we've shown it. I mean, record yen shorts. They better watch their back here.
We had 160 on Monday, and to be down here at 153 is just absolutely remarkable. I'm still trying to work out, I think, the big issue for a lot of people, speaking of narrative creep, the end of US exceptionalism, the beginning of convergence, the end of divergence, the beginning of people starting to pile into that trade, peak US dollar, peak yields, all of that stuff. Too soon? Too soon to get excited?
So I thought something really interesting happened the last 2 weeks on that score. The FTSE 100, UK, an index with no tech, right? Only 1% of the index is tech.
Guy Johnson calls it Jurassic Park.
Just made a new all-time high.
Does he?
Just made a new all-time high. The first index globally to come out of this correction at a new high is an index with no tech. That's an interesting clue, right? Look at what's breaking out in China right now. All these material stocks, all these basic resource stocks. That's a clue, right? So I think there's these little hints. It's a market that almost feels like it has one foot in some old regime, one foot in some new regime, and you're in this nasty, bloody war to see ultimately kind of who wins the heart and soul of this market. I'm leaning more towards the stuff in the ground, the real stuff, the basic resources, the parts of the market that don't necessarily rely on tech to propel you higher.
But to John's point, do you think it's peak U.S. exceptionalism, or the rest of the world is building up to where the United States is?
I'll let people far more intelligent answer that. But what I will say is I think this idea that the dollar has been strong this year is a misconception. I know DXY is up, but up against what? It's down meaningfully against gold. And if you want to talk about nominal versus real, these have not been new real highs in U.S. equities this year. These have been new nominal highs in U.S. equities. So if you look at, say, S&P versus gold, that actually has not even come close to taking out the 2021 highs. And that's not bearish or bullish. I mean, that was the case from 03 to 06, but that was a weakening dollar environment. So I just want to be a little bit careful how we talk about dollar. I know just looking at the chart, when we say, it's up this year, people are bullish, I'd be a little careful with that.
Build on that. I'm looking at G10 right now, just a snapshot of it on the Bloomberg terminal. The dollar's stronger against the yen by close to 8%, the Swissy by 7%. It's against every single currency in G10, the dollar's stronger. But we should measure it against gold. Is that right?
Yeah, I think when we're talking about fiat here, it's who's slightly less bad than the other. I think when we're talking about stuff out of the ground, I mean, look at the move in copper this year, look at the move in gold.
Iron ore now, too.
I think this is about hard assets over financial assets, and that's how I would approach the currency landscape here.
Interesting. Chris, great to catch up.
Always great to be
here. Good to hear from you. Thank you, sir. Chris Ferrone of Strategas. Let's get you up to speed on news elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Let's get a check on Expedia in the pre-market session, falling nearly 11%. Bookings in the first quarter missed estimates. It also cut its sales forecast for the year. It's yet another post-pandemic darling that's showing a slowdown in consumers' willingness, at least in the U.S., to pay up and travel. Booking, which owns Kayak and Priceline, also said that reservations would slow. Airbnb, for its part, had said that it would be hard to match the 2023 season. Amgen shares, for their part, they are surging in the pre-market, almost 14%, thanks to their push into obesity drugs. The CEO said he was very encouraged by a trial of their experimental drug. If approved, Amgen said that patients would use a handheld auto-injector just once a month, or even less frequent single injections. That compares to Wegovy and Ozempic. You need to take those once a month, and that potential competition has sent Novo shares down more than 4.5% this morning. A second Boeing whistleblower has died. A former quality auditor at Boeing supplier Spirit Aerosystems, who raised concerns about the safety of the 737 MAX jet, died just 2 weeks after developing breathing problems. That's according to the Seattle Times. In March, another Boeing whistleblower reportedly died from a self-inflicted wound. That's your Bloomberg brief. John.
Danny, thank you. Up next on the program, a record-breaking buyback.
There's going to be a lot that Apple's going to throw out there. I think you're going to potentially see higher price points out there. And again, why that buyback was increased out there.
That conversation up next, live from New York City this morning. Good morning.
It's Jobs Day, and Bloomberg has the report under surveillance.
Oops, we did it again.
We have a strong economy. Labor markets are tight.
We have to question, can the economy stay this resilient?
Today, Jonathan, Lisa, Annmarie, and Mike will bring you crucial data and expert analysis at terminal speed.
The jobs market is not deteriorating.
How long can that story keep holding for this Federal Reserve?
The source of this strength, we could debate it all day.
The April jobs report, today on Bloomberg.
Equity futures positive here by 0.4% on the S&P 500. The jobs report just around the corner. You're familiar with the numbers now. 240 is the estimate in our survey. Yields a little bit lower by a single basis point. 456.71 on a 10-year. What a week it's been in both bonds and foreign exchange. More on that a little bit later. Under surveillance this morning, a record-breaking buyback.
There's going to be a lot that Apple's going to throw out there. I think that is why they're excited. I think you're going to potentially see higher price points out there. Also, again, driving the conviction level on the free cash flow potential here going into calendar 2025. And again, why that buyback was increased out there.
It's the latest this morning. Apple shares rising in the pre-market. Second quarter results surprising to the upside thanks to better than expected sales in China. The iPhone maker forecasting a return to growth and announcing a record $110 billion share buyback plan, the largest in US history. Pierre Ferro of New Street Research has a neutral rating and a 175 price target on shares of Apple. He joins us now for more. Pierre, I want to go straight to sales, and then we'll get to financial engineering. Do you think the sales declines are behind us?
Yes, I think we are progressively reaching like a trough and a stabilization. It doesn't look like we're going to see like a major correction in sales. So I would say, yes, the decline is behind us. Things are stabilizing, but we're not going to have like a significant rebound from where we are today.
Well, that's what I want to get into. So JP Morgan are talking about a launch pad into the AI upgrade cycle. How much of a launch pad do you see in September?
Yes, I'd be very, very careful about that. If you look at what people tell me around on, the silicon of the iPhone, it doesn't look like this September product cycle is going to be a cycle where generative AI is like a revolution in terms of hardware. And if it's not a revolution in terms of hardware, can it be really like a revolution in terms of features and drive really like an upgrade cycle? So I've heard this argument a lot. People are asking more and more whether we could get into a very nice product cycle. I think it's too early to say, and I think it wouldn't be prudent to be overly optimistic. Generative AI is still in the making, and how you get that into an iPhone and create like a wow factor that really gets people, like gets really the word out and people willing to accelerate the replacement of their phone. I'd need to be convinced. And see what the future would look like.
Pierre, we're not convinced what's going on in China either. There seems to be a disconnect here between the guidance that we're getting from the company, what they're telling us is happening on the ground, and what independent researchers are seeing as well. What explains that spread, that distance between the company and independent researchers?
It's very surprising. It's a major surprise. We didn't see that coming at all. We were clearly expecting Apple to create like a much lower point in China. So unfortunately, I don't have an explanation for you, John. It's like it's something we'll have to better understand. In the next few days, we're going to try and circle back with independent research providers to understand in their methodology what they could have been missing or how the disconnect could be explained. So what we see is like the Chinese players coming back into the market, coming back into the higher end of the market, putting at risk, the 20 million odd units the iPhone won over the last 3-4 years out of a lack of competition in China. This is not materializing. So does that mean this Chinese phone went into the channels, did well in early weeks, but actually didn't convince consumers? that would be one explanation, but we need more research to figure that out. As I said, a very, very strong surprise, very, very significant surprise.
Yeah, and to build on that, the CFO of Apple saying the reality is different from maybe what you read at times about what we see in China. This raises a question of how much Apple either needs to address Xi Jinping diplomacy and kind of what the line is from authorities in terms of discouraging or encouraging people or allowing them to buy iPhones going forward in the region, or whether it really even matters. In other words, how much do you have to have clarity on this to still have faith in the stock?
Well, because things have stabilized and normalized, over a couple of years, you don't really have growth in iPhones. That the positive aspect of it is that it doesn't create that much of a downside risk, but also not that much of an upside risk. So I think the iPhone is like mostly like a de-risk standpoint. And so the only thing that could really create a surprise from here on the iPhone is like a significant product cycle. And of course, if that happens, it would have to be related to generative AI. That's like the new features the company is working on. So that's really where we stand. Not much is going to happen on the iPhone front until we see this product cycle. And my point is, like, building conviction on a product cycle for this September is probably too early. You don't have enough evidence of that coming.
Is this still a growth stock, or is this a value stock delivering buybacks that count for basically more than the value of both Ford and GM put together?
That's a good question. I would say I would struggle to call it a growth stock, but it's still a compounding stock. If you add up, the kind of like still excellent pricing power the franchise has, which means that prices can go in the right direction in low single digit every year, the growth potential in services and the excellent financial performance that translates into very good buybacks, it's still like a stock that can compound earnings and free cash flow in mid to high single digits. So that's a good compounder. And of course, the quality of the stock is reflected in the price. It's trading at a 50% premium over S&P names that have the same kind of growth potential, growth outlook. So it's an expensive single-digit compounder, I would say. And that's the reason why we're very neutral on this stock. We don't see major issues with where valuation or where expectations are. It's just that it compounds slowly.
Pierre, services was a relative bright spot for Apple, but they're obviously dealing with a lot of regulation around the world. Is there a ceiling on how much they could bring in from services?
Yeah, a ceiling is actually the right way to think about it, more than downside risk. So Apple has a lot of pressure. So you can't imagine like an aggressive move with an aggressive pricing and monetization strategy coming through in that environment. Now, what you see over the last 2-3 years is that the regulatory pressure, like the general, like I would say, public opinion pressure that Apple has on, like the very comfortable monetization they can exercise on the App Store, basically means that the take rate is eroding very slowly over time. But like now, like the risk of a major clampdown appears very, very remote. So services overall growing, in low teens with, revenues from Google for licensing continuing to grow, the App Store continuing to grow even if the tech rate is coming down, the volume on the App Store is still growing, and then Apple's in-house subscriptions. All these things are like nice, healthy, I would say, low teens growers, and like a reacceleration from these levels is very unlikely. But that growth is still very high quality.
Hey, Pierre, you're one of the best. It's good to hear from you. Pierre Ferro there of New Street. Neutral on the stock, 175 price target. Right now in the pre-market, we trade at 183 and positive by close to 6%. Coming up next on this programme, traders moving up rate cut bets to November. Terry Wiseman of Macquarie joins us next to discuss on this Payrolls Friday. Your estimate, 240K. So we're down on the week, we're up on the session, and the equity market right now on the S&P 500 futures positive by 0.4%, on the Nasdaq up by 0.7%, Russell pulling back just a touch. We're down about 0.1%. In the bond market, quite a turnaround this week. We had a little look at 470, backed all the way back down to 456.50 on a US 10-year. For 5 consecutive weeks, yields have been climbing on a 10-year maturity. Lisa, we're about to snap that streak.
And basically why? It's because Fed Chair Powell had a very big opening to come out and really out-hawk himself, basically come out and talk about how they can't take anything off the table. They're watching the data. They don't want to get this wrong. He didn't. He basically just came out and said, you know what, the next move is probably going to be a cut. We might have to wait a little longer, but we got this, as we heard Bill Dudley say. What I find interesting is the stock market is betting that the Fed's going to cut rates much more quickly than the bond market is, and that, I think, is more interesting.
The number one thing that you'll hear this morning, I think, around the payrolls report is going to be this phrase, asymmetric risk. It's a conversation we've had on this programme over the last couple of days, following those comments from Chairman Powell in that news conference. Alan Ruskin of Deutsche Bank put it quite nicely. So allow me the time just to go through this quote for you. Sudden weakness in employment could push for the Fed to cut rates and would be less responsive to more upside surprises. The market's reaction function should mirror the Fed's asymmetric policy reaction, leaving assets more responsive to weaker than expected data than to an upside surprise. Overwhelmingly, that is the consensus of people on this program at the moment.
Basically, upside surprise, no hike because they took it off the table. Downside surprise, cuts because they want to cut rates, and that's going to give a boost to stocks, period, the end.
They believe that yields can drop more than they can spike off the back of a bad number as opposed to a really good number. We can get a different view on that in just a moment, maybe. I want to turn to foreign exchange and talk about dollar yen. 153, what a turnaround. Had a little look at 160 on Monday, all the way back down. It's a 3 percentage point move in about 3 sessions. Lisa, it's been very, very difficult to keep up. I keep referring to the time in Tokyo. It's 7:31 p.m. in Japan. We're going to work out whether they want to get in even more a little bit later.
Basically, if we get some sort of disappointing jobs print, are they going to come in and smack down all the short sellers even harder and say, see, look, you guys are going to lose your shirts? To me, this is very much them trying to wake up volatility in a market that has been somewhat complacent that they're not going to step in because they hadn't stepped in. So this is a question of how much pain has been inflicted in the carry trades, in the hedge funds, et cetera, that have been trying to short this currency. I'd actually be curious to see some of those numbers.
Reintroducing some two-way risk into this market big time this week. Under surveillance this morning, shares of Apple gaining after announcing the biggest stock buyback in US history, $110 billion US. Profit also topping Wall Street projections despite continued headwinds in China. Apple has posted sales declines in 5 of the past 6 quarters. Is it the end of the sales declines going through to September?
Well, they kind of said yes. They kind of said that they see brighter times ahead. Where's the growth going to come from? Them talking about China being less terrible than everybody thinks? Well, why is the independent data showing something different? Kind of a mystery right now.
And it's also a mystery because we're at what I feel like the start of potentially tit for tat in terms of geopolitical relations between Beijing and Washington. If you work in the government, part of the Chinese Communist Party, and work in Beijing, you cannot actually have an iPhone. How much worse can that story get? Tim Cook, though, yesterday says you all need to take a step back from the 90-day cycle. What I see is a lot of people moving into the middle class in China. We clearly have work to do there, but he says he thinks they've been through it. It's the last quarter, and it's the most competitive market still in the world.
I do love CEOs on the call. Step back from the 90-day cycle, unless the 90-day cycle is an absolute blowout number, in which case embrace it. Was that Ambassador Cook? You've alluded to this. Was that Ambassador Cook on the call, or was that the CEO of Apple?
So I'm not a conspiracy theorist.
But
I would. Well, I just think that there is this question of Elon Musk going over and kowtowing to Xi Jinping and getting some concessions from him. Is there a feeling in China that they want to lure international businesses to their country so they can't really make it absolutely inhospitable for some of their biggest international companies that are both employing people and selling products? So how much are they getting a nod from Beijing that they're not going to go further? I'm not saying that that's the truth. I'm just postulating that that could be some of what's behind it.
Of course, just thinking out loud. Apple's up by 6% in the pre-market. Our next story, payrolls. That report about 2 hours away. The median estimate in our survey, 240,000. Goldman Sachs were the most bullish out of the big banks on the street, looking for 275. UBS at the low end, expecting 200. Elsewhere, traders pulling rate cut expectations up to November after Fed Chair Jay Powell's press conference was less hawkish than feared. The bets coming as short-end treasuries saw their best 2-day rally since since January. Terry Wiseman of Macquarie with a warning saying this: as happened after March 20th, we expect that the Fed speeches and appearances coming up will be more hawkish than Powell's discourse and help prop bond yields up, not down. Terry's with us around the table. Morning, Terry.
Good morning, Sean.
Are you saying that maybe Chairman Powell didn't do the best of jobs reflecting the consensus on the committee?
That's exactly what I'm saying. Look, March 20th, I think he got smacked in the face in the few weeks subsequent to the March 20th FOMC meeting. I mean, he was an ultra dove there. I wouldn't say he was an ultra dove this time. I think he was more middle of the roadish, but that was still a surprise given that people thought he was going to be hawkish. But go back to March 20th. That time, he was an ultra dove. And in the week subsequent, he got some high inflation prints, he got some strong data, and he got a lot of the regional Fed bank presidents and a lot of the other governors from the Fed coming out in their speeches and appearances, basically saying, look, we are not as dovish as the chairman. There might be a situation we may have to stay high for long. I think some of the Fed speakers even opened up the prospect of a rate hike at that time. So it's very possible that in this discourse on Wednesday, he was not reflecting the median view of the 19
well, let's get into that. Where specifically?
Policymakers or the FOMC and decide to go a little bit off the rails.
So Goolsby speaking a little bit later with Michael McKee. Look out for that interview. We'll hear from John Williams of the New York Fed as well. Where specifically would you expect there to be division with what Chairman Powell said in that news conference? What topic do you think there's going to be the biggest spread?
You know, Jay Powell has a knack for not talking about the long term and structural issues. He touched a little bit on immigration, but that is really a short-term issue, right? It's reflecting what happened over the last year. I expect that there are going to be some Fed speakers who are going to stick to a little bit more of the structural themes. What is the implication of deglobalization, for example, for inflation? What is the implication of demographics more generally and the baby boomers retiring? What is the implication of global conflict for inflation? All of these things tend to be inflationary in the long term. And I think that there's a lot of hawks among the policymakers at the Fed who actually believe that the long run appropriate policy rate should be higher. You can see that in the dispersion of the dots on the long run projections. And I think that's what's going to come out of these speeches and these appearances. And I think the market's going to realize, just like they did on March 20th, that Powell is a little bit taking his own path here and did not really reflect the tone. You can see the tone, by the way, in the statement. The statement was very clear in the first paragraph that the Fed was frustrated with the lack of an ongoing decline in inflation. And that was exactly what he chose to disemphasize or de-emphasize.
With all due respect, I feel like sometimes the market is looking for some clarity from Fed officials who have none. They are basically in the same black box that we're in, looking around, trying to understand the paradigm, trying to understand what the potential data that we're getting actually means. You know, I started talking about narratives early this morning, got slapped down saying you can fit whatever narrative you want into whatever data points you want. I mean, how much is this a market that's just going to trade in a much bigger range with every single economic print just because we don't have some sort of set paradigm set by either Fed officials or by the market?
Well, I would say we do have a paradigm. It's not maybe the paradigm you want to be trading alongside. It's the paradigm of data dependency. And I know that's a terrible paradigm because it's not model driven, it's data driven, and it forces everyone to react to the latest, the latest release of data, as we're going to see today with the jobs report. That's unfortunate. But I think we're living in a world where we have been buffeted by a lot of supply shocks, not just demand trends in the last few years. And I think because of that, the paradigm should shift to considering more what the supply side is doing. And unfortunately, the Fed does not have a model for that. To the extent that they have any models, they are still stuck in a Phillips curve-driven world. And that seems to be a model that is much more driven or informed by aggregate demand stories and aggregate demand management stories.
In a data-driven world, it is 7:38 p.m. in Japan right now, as John's been mentioning, that there's a very close watch on U.S. data over from Japanese authorities who are trying to stave off some of the weakness in the yen. How much are they reintroducing an extra level of volatility in currency markets by trying to blow out the shorts, by trying to actually create a greater price fluctuation to make sure that speculators can't really have an easy time of it?
Well, I don't think the volatility is what they want. I think stability is what they want. I think what they feel is that it's the traders who've introduced instability into the marketplace by virtue of their speculation in dollar yen. Believe it or not, by creating this short-term volatility, their intention conceivably could be to produce medium-term stability or long-term stability, because in doing so, they take the speculative element out of the pair. It's not in central banks' interests, certainly not this central bank's interest, to be predictable, right? And what I hate, especially, is when economists look at what happened in the fourth quarter of 2022 and say, oh, well, the BOJ intervened twice back then, so we should expect them to intervene twice again, and maybe once they've intervened the second time, it's over. That's not the way to think about it. If anything, they want to do something different because they want to keep speculators on their toes. If speculators are on their toes, they will not fight the central bank. They will not test the central bank. They'll stay away. They'll stay cautious, and that will introduce stability in the longer term.
How much, though, is there sort of a broader sense that what happens in the U.S. will dictate how far some of these other central banks can cut rates, how much they can potentially really just manage their own economies rather than looking to the Fed?
No, this is a great question. They have to look at the Fed because to the extent that the Fed acts and the other central banks don't, it can introduce volatility into the foreign exchange of these countries. But this is only pertinent if they're worried about volatility in foreign exchange, or if they're worried about the levels that their exchange rates have gotten to. I don't hear from the central banks these days, with the possible exception of the BOJ, obviously, that may think that the yen has gotten too cheap, that they're concerned about the levels of their currencies. Keep in mind, the Europeans still would like to promote some competitiveness, especially vis-a-vis China if you're Germany, potentially vis-a-vis the U.S. if you're the other countries in Europe that want to promote, say, tourism or other service exports. They're not. I don't hear that the Europeans, for example, are concerned that the euro has gotten too weak. That's not out there at this point.
Our prior guest was talking about the fact that he doesn't actually think the dollar is even that strong right now. Where do you see the trajectory of the dollar year end?
Well, I think it all depends on what the Fed does. If we go back to that discussion, I hate to bring everything back to the Fed, but it is important. But if the Fed were to start cutting, I think the dollar eventually, and I say eventually, we're not talking about the next month, but maybe the next 6 months, will start to retreat, will start to fall. There'll be an organic decline in the dollar versus the yen, and the BOJ will not have to do what it's doing. Okay? But that is conditional on seeing some slowdown in the U.S. and some diminishment of the inflationary impulse that we've seen recently.
Just quickly, how bad does this number need to be today? I'll ask this a few times today. How bad does it need to be today to talk about rate cuts this summer?
So it's interesting. I think that Jay Powell, in his discourse on Wednesday, was trying to tell us not to look at non-farm payrolls. Remember, he talked about immigration at the very outset of his talk, and he seemed to be making the point that the reason we're having strong payrolls growth in the U.S. is exactly because we have strong immigration. And if that's the case, you can't see strong payrolls growth as inflationary. What you should be looking instead are other ancillary measures of job market strength, like turnover in the job market, like wages. And let's keep in mind that wage growth in the U.S., if it's measured by the average hourly earnings, has not been very strong. It's actually been on a downtrend for the last 6 months. And if we get a low wage growth number and a high payrolls number, I think the market will accept what Powell said and effectively be calm about that, and we will not see an adverse reaction in the bond market. But that's a view that pertains to today. I think if the Fed speeches come out in the next few weeks and they're more hawkish, I think you can see bond yields rise again.
We'll see how well educated the rest of the market is at 8:31 Eastern Time. Terry, thank you.
My pleasure.
Terry Wiseman, thank you, sir, of Macquarie. Equity futures at the moment positive by 1/3%. Let's get you your Bloomberg brief, an update on stories elsewhere with Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Rishi Sunak and his Conservative Party have suffered a major setback. Labour won a key seat in Parliament where voters in Blackpool elected to replace the previous Conservative MP who had resigned in scandal. The results themselves show the third largest swing from Tory to Labour votes since World War II. Political scientist John Curtis said that the Tories were on course for one of the worst, if not the worst, performance in the last 60 years. Deutsche Bank is planning to double its AUM for high net worth clients in Southeast Asia and the Middle East. The head of private banking told us that they're going to invest heavily, and a bulk of future hiring from the bank is going to happen in those regions. The strategy, though, pits Deutsche Bank against UBS, which is also targeting growth in the same regions. Now, we have an update on campus protests at Columbia University. The school has now reported that 13 of the 44 people who occupied and barricaded themselves inside a campus building had no affiliation with Columbia. The numbers from City College of New York are somewhat similar. Mayor Eric Adams said that 60% of protesters arrested were unaffiliated with the school. At this point, more than 280 people have been arrested at both New York schools. And that's your Bloomberg Brief, John.
Danny, thank you. Appreciate it. Up next on the program, US payrolls on deck.
We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization. And more than that, I think we need to see wages. I think that's the important part.
We're looking for 240 today. That conversation is up next, live from New York. This is Bloomberg. Counting it down to the payrolls report with equity futures shaping up as follows. We are positive by 0.4%. We are up on a session. We are down on the week and looking to do something about it. In the bond market, the yields are lower by 2 basis points, 4.56. That has been quite a turnaround this week. And in the FX market, the euro is a bit of a snooze, around 107. The entertainment value has come from the Japanese yen, dollar yen, 153 after a sneak peek of 160 at the start of the week. Under surveillance this morning, US payrolls on deck.
We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization. And more than that, I think we need to see wages. I think that's the important part. We need to see wages sort of continue to be on the decelerating path that they had been. I think if we see both of that, the labor market, the rates market and the equity market gets a little bit of confidence.
So here's the latest this morning. Less than 2 hours away from the April payrolls report, Sarah House and the team at Wells Fargo expecting a gain of 250,000, slightly higher than the median estimate in Bloomberg survey, calling for a print of 240k. Sarah writing the following: despite the evident strength in the job market, there are some chinks in the armour. However, resilient spending and robust economic growth ought to be supportive of further growth in payrolls. Sarah joins us now for more. Sarah, wonderful to catch up with you once again on a Payrolls Friday. A more complete picture for us, please. What do payrolls look like alongside wage growth a little bit later this morning?
Right. So as you mentioned, we're looking for an increase of 250,000 in terms of payrolls. So still a very strong gain, albeit a moderation from the trend we've seen over the past 3 months or so. But we're also looking for moderation in terms of that trend in average hourly earnings. So looking for a 0.3% print, which if realized would bring that year-over-year rate down to 4%, the lowest we saw since the midsummer of 2021. So expecting to see at least some further deceleration in terms of that overall trend in average hourly earnings, even as nominal wage growth does remain elevated relative to the past cycle.
Could you help us understand the upside risk around the wage growth story off the back of the law passed last year in California that raises this minimum wage for fast food workers to, I think, $20 per hour? That took effect in the month of April, Sarah. How do you calculate what kind of maybe impact that's going to have on this number this morning?
Yeah, so I think overall it's still going to be a pretty minimal impact because at the end of the day, these are some of your lowest paid workers in the economy. And so it takes very big increases in that segment. And this is only for one state, albeit the largest. And so I'm not sure how big of a impact that's going to have in today's numbers. We tend to usually get pretty amped up about these increases in the minimum wage. But again, these are the lowest paid workers, so it doesn't tend to really move that average.
Sarah, Jay Powell really doesn't like the word stagflation, but other people keep using it, including Michael Hartnett over at Bank of America, where he said that the distance between a stagflation read, where you get sort of a 125 type print with a 0.4% wage growth, is probably the worst case scenario for risk assets versus 225 and 0.2% wage growth, which could confirm this sort of Goldilocks disinflationary employment. Do you agree with that assessment? That is sort of how quickly we could have a narrative shift depending on these numbers?
Well, I think markets are, of course, looking for any additional information. But as we know, both the payrolls and the average hourly earnings numbers can be pretty volatile. So I think in order for that narrative to really take hold, you would need to see multiple months of that. And while we are looking for a moderation in payroll gains, it's hard to see such an abrupt shift coming, given that in some industries like leisure and hospitality, there is still scope for a lot of catch up in hiring. We see a lot of strength in terms of some of the secular hiring in areas like healthcare. There's still some catch up going on in government hiring. And so it's difficult to see that abrupt shift, let alone on a sustained basis here in the near term. But of course, that is the worry, given that we have had relatively tight monetary policy for close to 2 years now. And we keep waiting for that impact to hit the overall hiring numbers.
We've been talking on this show for quite a while, and John was bringing this up earlier, that there's sort of an asymmetry in terms of what we get, where there's no sense that the Fed could possibly hike rates. So we're not going to see any potential bake-in of rates going much higher from here, but they could potentially cut pretty quickly. if we do get a disappointing number. Do you agree with that? What would we have to see to start thinking about rate cuts sooner?
Yeah, I think you'd really have to see that lurch lower in payrolls. So we've seen a lot of other metrics of the labor market point to some gradual softening, overall cooling, like the job openings and turnover, like we've seen in some of the PMIs in terms of their hiring. But the fact that you've just seen hiring in terms of the non-farm payroll numbers remain so robust, it's been hard to say that the jobs market really is weakening. And so I think if you were to see a big move lower in terms of the payrolls, then that would really shift, I think, the overall thinking in the jobs market and potentially keep it where, or at least put a potential summer rate cut back in play. But it'd take more than just a weak April number. I think you'd also need to see that repeated in terms of the May data next month.
The unemployment rate has been below 4% for 26 consecutive months. This is a huge feat for this labor market. But what kind of unemployment rate would you think the Fed get very nervous about? 4 point what would mean potentially they come in for a cut?
Yeah, so we heard Powell on Wednesday say he's not worried about a few tenths increase in the unemployment rate. In some ways, this is by design, of course, by their stance of monetary policy. And so I think you'd probably need to be getting closer to at least 4.25%, maybe 4.5%. But of course, the speed also matters. So we've seen the unemployment rate move up from 3.4% close to a year ago to that 3.8% today. It's hit 3.9, but it's been very gradual. So it's been part of that slow normalization process. But if you started to see the increased pickup speed, then I think that would send up some antenna, and I think would make the Fed a little bit nervous about the direction and the momentum that we're seeing in the jobs market.
When you look at the jobs market, obviously immigration has been a huge story. It's also depressed a lot of wage concerns. At what point, though, does it maybe become inflationary? Because there are still people out there in the market making money and they're spending.
Yeah, so I think overall that when we think about the jobs market, I think it's helpful for disinflation. When we think about the immigration and the rate of participation among foreign-born workers, it tends to be higher. And so on net, this is a population segment which tends to contribute more to the labor market versus the growing retirement age population, which is just in their consumption years rather than production years. So I think, at least for now, for the jobs market, I think it's still an encouraging aspect of a disinflationary trend in wage growth resuming here as we move through the year.
Sarah, I've got a great stat from our colleague Chris Dancy on this median estimate today. The estimate's 240, we know that, but that's the highest median forecast before payrolls since September 2022. Sarah, to some extent, and please explain your own experience of this, have we been undershooting payrolls on Wall Street to such an extent that this month is the month where everyone starts sort of adding an extra 25K on top just to make sure?
Well, I think we've actually been adding some, economists have been adding some on top of it, given that this undershooting pattern has been going on for the better part of the past 2 years. But it still hasn't been enough, as we've seen the consensus undershoot the actual first print in 21 of the past 24 months. And so I think we have been adding that in. But at some point, we might overcorrect in that aspect. So we'll see if today's today. But I think there has been acknowledgement that the models just still aren't picking up in terms of the magnitude of job growth. And so there's been some add factor, at least I know on our end, from that.
Interesting. Sarah, thank you. Sarah House there of Wells Fargo. A little bit of transparency there on how the sausage is made on Wall Street.
I could tell kind of where you were going with this idea that if you're baking in more, are we more prone for a downside surprise because people are just cracking up what their
conditioned by experience, right? You know, how many times have we sat here, 8:30 Eastern time, Mike McKee, upside surprise, repeatedly, the last 2 years?
Well, people have been totally overwhelmed by this immigration story, and I think that's what we keep seeing from a lot of research reports. Raises this question of how are they managing for understanding the unemployment rate? How are they understanding the entire labor market if the actual rote numbers are somewhat different, and then they just have to tack on some extra just to account for what they don't understand?
They're struggling to understand, I think is the simple way of putting that. Going into this payrolls figure in the next hour of Bloomberg Surveillance, we'll count you down with Priya Misra of JP Morgan, Terry Haynes of Pangea Policy. We'll catch up with Stefan Slowinski of BNP Paribas on his downgrade on Meta, and we'll speak to Morgan Stanley's Annmarie's Sarah Wolf. All of that still to come, with equity futures positive 0.33%. Bond yields a little bit lower by about a basis point. Let's call it 4.57 on a US 10-year. From New York, this is Bloomberg.
I think that markets have actually moved away from this soft landing idea.
Powell basically dismissed any notion that they would hike. So the focus is very much on when they will cut.
The market has been very excited about the possibility of hikes. I think he closed the door on that tail very clearly.
The market is adapting to higher interest rates. This is actually a kind of a reasonable setup for equities here.
The market is beginning to get it, that it is normalization of interest rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City. Good morning, good morning. Equity futures positive by 0.33%. Here's the playbook for you through the next 12 hours or so. Payrolls report, 8:30 Eastern time. 90 minutes after that, we get the ISM services data. Don't miss that. It's important. Then we get the Fed speak following Chairman Powell. Mike McKee sitting down with Goolsbee of Chicago later on this evening with Goolsbee, the New York Fed president, John Williams. That is a stacked day, Bramo, into the weekend.
Especially after what a lot of people thought was a surprising press conference from Jerome Powell. There was a feeling from other Fed participants that they were more hawkish than how he led on. John Williams even entertaining the prospect of a rate hike. We didn't hear that at all from Jay Powell. He took that off the table. So at what point do we see them start to reintroduce that risk? And does the market care? Or do they say Jay Powell has our back?
What does it take to reintroduce the rate cut conversation is what I really want to talk about. How big does the downside surprise need to be? How soft does wage growth need to be? For all of a sudden, the markets start thinking, OK, maybe July could work.
There is a feeling right now that is increasingly getting baked into markets that it won't take that much. Jay Powell seemed to say it'll take a lot. We're really on hold. We're concerned about inflation. The market said, really? And that's, I think, where a lot of people are.
On Payrolls Friday, we're not used to downside surprises. For the best part of 2 years, we've sat here, looked at the number and said, yeah, another upside surprise on payrolls. 240 today. Annmarie, that bar is getting just a little bit higher going into this.
And that's because the supply side of this labor market. You go back to the CBO report. Normally, they would bake in about 1 million immigrants coming into the United States. It's 3.3 million now in net immigrants arriving last year in 2023. What does that mean for the data in 2024? And it's this new paradigm almost of the population growth, immigration growth in the United States. That is why you see forecasters coming up and saying, actually, probably should add another 10 or 20K to this print.
It makes it harder and harder to understand this economy and the connection between what we're seeing on payrolls and what we're not seeing in wage growth.
Yeah, my mind's mush. I mean, I'm going to be really honest, and for a lot of reasons, I'm sure, but partly because it's just so many conflicting. Yeah, well, so many conflicting. No, it's all right. Let's move on.
We're not live or anything.
All right, let's move on, please. But so many conflicting narratives. I better just get out of this before I go downhill. But there's this question of, okay, so are we going with this rolling recovery and rolling recession that can cushion any kind of material downside? Or is this all just noise that's masking real weakness below the surface that we're seeing from a lot of companies and hearing on their conference calls?
Nice. I'll change the topic. We'll go to one company.
Fabulous.
We'll talk about the biggest one, one of the biggest ones in this country, Apple. We're up by 6% in the pre-market. I don't want to talk about the engineering, the product intervention, innovation, or lack thereof. I want to talk about the financial engineering, a $110 billion additional share buyback program. Bramo, just stunning numbers, a record in US market history.
Let's put this into perspective. If you add the market capitalization of Ford and General Motors together, it still is not as big as this one share buyback. That is how big this share buyback is. And they've done a number of other significant share buybacks. There is the history of all of the largest buybacks, which mostly are Apple. So it raises a question, is this a growth company? Or is this, what did you call it, Annmarie? A heavy
fat
set,
middle age, according to Richard Windsor, not me. I did not call it that. That was Richard Windsor who's saying this is basically a middle-aged company.
Well, if that's the case, don't underestimate that, because frankly, a lot of people like what they see, given the fact that they're actually redeploying their money.
Apple's having a midlife crisis. That buyback's what, a Harley Davidson? Is that what we're doing here?
Kind of. That's what Richard Windsor says. But you know what? You look at the share price, you look at the buyback. This is obviously assuaging a lot of investors' concerns about what's actually going on in China, which is their growth market. And Tim Cook yesterday came out in the call and said, let's take a step back. Jonathan, take a step back.
I'll take a few steps back, all right.
From the 90-day cycle. and look at potentially the future of this market in China. I just think the future in China looks more gloom for these companies. You already see a lot of these customers moving to homegrown brands. Why would that stop?
I'm not sure Harley's happy this morning either, being the poster child still of midlife crises. Is that still a thing? Do people buy a Harley?
I'd rather a Porsche.
There are other things. I think like
What
you want me to insult somebody else? How much do you think that the Apple Vision Pro turned out to be a midlife crisis? Because you had to have enough money to pay for it.
$3,000.
$3,000. So you couldn't just be a young gamer. You had to actually be desiring to experience a new type of life. I don't believe in midlife crises.
You don't believe in them? Okay, good. I mean, this is going well, isn't it? You don't. Oh, right. Equity futures right now on the S&P 500 look like this. We're positive by 1/3%. You need to tell me more what you mean by that. Yield to lower by a single basis point, 456.91. 107.45 on the euro. I'm still waiting. Crude, positive by 1/3%, 79.21. I don't think I'm getting an answer.
Nope.
Can we get this out?
JP
Morgan's Priya Misra with a jobs report about 90 minutes away. Terry Haynes of Pangea Policy ahead of Secretary Yellen's speech a little bit later. And we'll catch up with Stefan Slawinski of BNP Paribas on why he's downgrading Meta to sell. We begin with our top story. Equity markets edging higher ahead of the jobs report. The median estimate in our survey is calling for 240,000. JP Morgan's Priya Misra saying this: I think a strong number is priced in. We'll react more if it's a weak number. But I think that the more important release is wages. A weak number will keep the labour supply story alive. A strong number is bad for bonds and stocks. Priya's with us around the table. Priya, this word asymmetry, heard it so many times. Can you talk to us about the asymmetric risk around this number?
Sure. So I think Chair Powell sort of highlighted that asymmetry, because when he was asked about, the path for policy, he said either stay on hold if the soft landing continues, and they could cut, by a certain amount. If inflation comes down, they could cut a lot more if growth weakens. So I think that reaction function, ultimately what we get in a Fed meeting is the reaction function. The Fed reaction function here is very clear. They're worried about the employment side and inflation. He told us very clearly throughout the press conference that compared to a year ago where they were concerned about inflation, the fact that inflation is now sub 3%, they actually care about the employment side. Now, I think if we get one weak number on NFP, I don't think it matters as much. But you get a couple of weak prints. We start to see consumer spending slow down. Consumer spending, I would argue there are cracks in there. Credit card delinquencies are picking up, auto loan delinquencies. There are cracks in the economy. I think the Fed is really hoping that they stay extremely thin, that they manage to cut rates just enough to sort of take the edge off. But what if they are not able to cut? And at that point, I think they can get a lot more aggressive. They can cut a lot more. And that asymmetry is not priced into the bond market, I would argue.
Well, let's hold on to that theme. Talk to me about how it should be priced. I think Lisa's been brilliant this week about separating the front end from the long end. So let's start with the front end. Have we put a ceiling, introduced a ceiling into the front end of the curve?
Absolutely. I think the Fed was very clear. Chair Powell was very clear. The bar to hike here is extremely high. I think the Fed doesn't have, and rightfully so, doesn't have a lot of confidence as to when will inflation look like it's going back to 2%. They have a lot of confidence that monetary policy is restrictive. They don't know how long they have to keep it there. There was not any talk of rate hikes. He was asked again and again. And so I think that's what creates that asymmetry in the front end. Now you talk about the long end, we start talking about how much should you get paid to take on duration risk. And, there's a lot of treasury supply. There's not a lot of net corporate supply, though. So I think when we talk about supply, we should look at total fixed income supply. But, I would say that ceiling in the long end is a little bit higher than the front end because there's a lot more that goes on. It's not just the Fed. But even there's a bit of a ceiling. If the Fed starts to cut rates, all this $6 trillion that's sitting in money market funds, which has felt safe and good, is not going to feel that safe and good, because now the reinvestment risk, the regret of I didn't put this money to work when I could get 6% in investment grade corporate, I think that starts to factor in. So I think there's a bit of a ceiling in the long end as well. I would say 5% is still a good ceiling to think about in the long end.
So you don't think that people are going to get concerned about runaway inflation, or the concern about a Fed that isn't going to do enough to bring us back to something that is a familiar paradigm to invest in longer-term bonds?
So between 2 and 3, what's 100 basis points on inflation? Now, I'm not kidding. I mean, it is important.
Depends what you're buying.
The Fed will always say that 2% is their target, but 2 to 2.5, 2.8, hard to argue that is runaway inflation. But I think that's why wages is extremely important. If wages head to, we're about 4.1, we get to 3.5 to 4%, that's consistent with a 2 to 3% inflation. So if that's the run rate of inflation, I think this concern around inflation risk premium running up or inflation expectations getting unanchored, I think it puts a lid on that. I mean, if you're talking about 4 or 5% inflation, I think it's a different story. But I think that's where the Fed is going to say, absolutely not, we're not going to cut rates. They're committed to this sub 3%. I think they have a slightly looser inflation target than they're suggesting.
So are you more bullish on bonds today than you were on Tuesday?
Absolutely. I mean, there's a fine line between having confidence or losing confidence that inflation is heading lower and concern that inflation may be heading higher. That's what I was watching for in the press conference. If I got the sense, one data print they can talk away, 3 in a row of high inflation prints, would the Fed say that they are losing confidence, inflation may be re-accelerating, the looser financial conditions might be actually resulting in re-acceleration, in which case hikes come back? We heard clearly from the Fed, they don't have a lot of confidence how long they will keep rates here, but they have confidence monetary policy is restrictive. They can just keep it here and the next move is a cut. So I think that concern, the last time I was here, I was saying 3 in a row and maybe the Fed starts to talk about hikes. That's off the table. I think they put in a few hawkish elements. I think the way the hawks have been quietened have been to say, we'll just keep rates here for longer. Let monetary policy do its work. Sometimes you just have to let like a good wine breathe. I wonder if that's what the Fed is saying, that you have to just let policy work.
Yeah.
Because I think they see the cracks.
The bottle of red's in the decanter, just sort of let that one go.
At least
for a few
15
months.
minutes.
15 minutes.
A few months.
A few months.
That's a
Priya's saying
terrible
a few
recipe.
months. I'm just asking.
Is that how long you age your wine?
I'm asking what you do with your wine. Forgive me. I'm sorry, Bramo. Bramo fired up about red wine. I know where this weekend's going. Priya Misra, I want to continue this conversation. Are you saying that people are starting to understand that reinvestment risk is real and they are starting to look further out along the curve? Or are you saying that once they do start cutting interest rates, that's when people start to wake up?
I think you wake up when that money market yield falls. I mean, that's when you get the wake-up call. But people, I think markets are forward-looking. And what I was getting concerned, I have to say in the last month, was do people start worrying about hikes? And then if I'm trying to move out the curve, well, if they are hiking, I'm going to get more in my front end. If the hike tail risk, or if I think of the distribution and they've truncated the distribution and hikes are off the table, well, then I can look at the forward curve. Plus, look at how much the market's repriced. We went from 6-7 cuts to less than 2 cuts this week. As of pricing right now, we're less than 2 cuts. There's still a lot of months this year. And I know the market thinks that the Fed can never cut into an election. No, they'll set us up. They'll let the data talk. And I don't think that they're politically motivated. So I think they can absolutely cut all the way up until November. There's time. I think the market pricing tells me that if you look at how much we've repriced, well, you're supposed to start to move out the curve. And we've seen the flows into IG, into high yield.
We're going to have that political conversation in just a moment. Priya's going to stick with us. Equities right now on the S&P 500, positive by 1/3%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. So Daimler Trucks dropping nearly 5% in the morning session. I spoke with the CEO earlier. He told me that, yes, Europe demand is waning and they might have to slash output. But he said North American markets are still very healthy. And perhaps relevant for this jobs day, he said that inflation pressures weren't broken, especially because of wage inflation and what he said are still tight labor markets.
It's still tight. We have, when we want to ramp up factories, I see it with suppliers, it's still not in a good position. Think about truck drivers, consistent shortages despite fairly high wages.
So that's the CEO, Martin Daum, speaking with me on Bloomberg Brief, which you can watch every morning at 5 a.m. Eastern. Wells Fargo says that U.S. authorities are taking a closer look at consumer complaints over payment platforms, including Zelle. Wells now joins its larger rival, J.P. Morgan, in acknowledging that there's behind-the-scenes interest from regulators about how the banks are handling fraud claims, disputes, and more from the likes of these payment companies. Democratic senators, including Bank Committee Chair Sherrod Brown, have publicly called on Zelle to clarify its policies and broaden consumer protections in the event of fraud. The NBA is close to signing a record broadcast deal. It would be for $76 billion over the next 11 years. To put that in context, that is 3 times the size of the current deal they have. A framework for deals with both Disney and Amazon have been worked out, according to people familiar, who said that it would be surprising at this point if either conversation fell apart. Before this, some industry experts had questioned whether the NBA was seeking too much. Clearly, that's not the case. There's still strong demand for live sports, and aggressive new bidders like Amazon have helped pump up the payday. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the program, defending the Fed's independence.
If you take away Fed independence, investors are going to get jittery. I think markets will throw a pretty cold bucket of water on the president if he tries to do that.
That conversation up next, live from New York. Good morning. It is Payrolls Friday. The scores look like this on the S&P 500, positive by 1/3%. In the bond market, yields are lower by a single basis point. Your 10-year, 4.57. In the FX market, the euro stronger, dollar weaker, 107.48. Under surveillance this morning, defending the Fed's independence.
It's not going to work very well. I mean, it's going to be obvious that it's not working. If you take away Fed independence, investors are going to get jittery, inflation expectations are going to go up, the dollar is going to tank. So happily, for better, for worse maybe, I think markets will throw a pretty cold bucket of water on the president if he tries to do that.
So here's the latest this morning. Treasury Secretary Janet Yellen set to deliver remarks later this afternoon defending the independence of the Fed, following a report in the Wall Street Journal that Donald Trump's allies had outlined proposals that would give the president more direct influence on the central bank. Terry Haynes of Pangea Policy with this to say: the Treasury Secretary giving nakedly political speeches makes investors either a little more nervous or invites investors to take Yellen a little less seriously. Terry joins us now for more. Terry, wonderful to catch up with you, sir. Before we get into the nature of Janet Yellen's comments, can we just get into what she's actually defending and where that comes from? Can you walk me through this? The Wall Street Journal report, I still haven't heard anyone come out on the record and make this suggestion. What did you make of the initial report from the Journal?
I think what happened with the Journal report is they got a bunch of staffers who are all elbowing each other to try to impress the boss and are coming up with all kinds of ideas, and so that's what you get. Yeah, the reality of it. I mean, I'm always happy to front run Ken Rogoff. I wrote on Sunday exactly what Rogoff said on your air on Tuesday, that the likelihood of this happening is close to zero. In a practical sense, the investor, the funders that Trump is trying to court right now aren't going to take well the idea of Trump pushing Fed independence. It's going to roil markets, to say the least. And on a constitutional sense, the Fed is not Trump's to deal with. The Fed is not some fourth branch of government. The Fed's powers come from Congress, and whatever you think about Congress, Congress is going to defend its constitutional powers. So the likelihood of somebody attacking Fed independence successfully from the White House is slim to none.
Terry, let's go to your note today ahead of Janet Yellen speaking at this McCain Institute. You say she traded in the independent, respected financial policy actor reputation for much diminished one of a foot soldier in Biden's army. Doesn't the market already view her as that, given we've seen almost this evolution of former Fed Chair Janet Yellen to a political Treasury Secretary Janet Yellen under Biden?
Yeah, I think so, to some extent. But, there's always people out there that go, well, Yellen said this, Yellen said that, as if it matters. Her performance in office, I say this with no disrespect, but her performance in office is one where she's sent out to defend policies that somebody else is putting together, by and large. And that's not a good look. This Friday speech is being touted as the economics of democracy and meant to sound like an echo of the threats to democracy that the Biden campaign is going on all about. Whatever else you think of a senior United States policy official. They shouldn't be sent out there to mimic campaign points because that doesn't create confidence in policy and doesn't create confidence in the administration, I think.
Terry, you said something there that I want to pick up on. The fact that she's a policy taker, not a policy maker. Isn't that this entire White House?
Biden, like any president, has pluses and minuses. One big minus, I think, and I've thought this since 2020, it's been a line running through my commentary ever since then, is that successful presidents, particularly successful presidents, need people who are more peers than anything else. If you think about past administrations, many had peers, right? Even Carter, who's thought to have a failed presidency, put Paul Volcker in charge of the Fed and nominated Volcker. And Treasury secretaries and the like have generally been people who are peers and who can advise presidents. This president has staff. And literally, I mean, a lot of former staff are now in positions of serious authority. What this means is, you don't have anybody to give you a BS detector, and BS detectors are very, very important in politics and in business. And Biden right now, I think, doesn't have that and never has had.
Interesting. Terry, next time we'll talk to you before we talk to Ken. I promise. Terry Haynes of Pangea Policy. Terry, thank you. Priya Misra with us around the table. Priya, you touched on this. Some people believe we can't cut in September. Let's go back to 2012. QE3 announced September 2012 before an election. Why can't we cut in September?
Exactly. I think, the Fed is data dependent. They've got a very clear mandate. They're trying very hard to keep that soft landing going, which is why I think they're telling us hikes are off the table. If the data suggests, now for September, I do think a few things have to happen. Wages have to decelerate. Inflation you have to have the next couple of CPI prints actually come in weaker than the last three. And you have to see signs that growth is slowing. I think at that point, now Chair Powell did say not 1 or 2 tenths on the unemployment rate. We're looking at 4.2, 4.3 on the unemployment rate. I think at that point, the Fed looks at the totality of the data. See, here's the other thing. Where's the starting point? We're at 5.5 on the funds rate. So I think the bar is actually not that high for them to start to cut. We talk about next year, I'm a lot more conflicted. I mean, we have an election. We could have pretty different fiscal policy. I don't know how much they cut next year in a soft landing, maybe only a couple of times. But the start in September is you're at 5.5, you get a few things going, they can start the process.
Nobody touches 2025. You notice that?
Yeah, nobody does.
No one wants to talk about it.
Because how can you even begin to imagine what it is?
Some economists say we're going to have runaway inflation if we have a tariff roll around the United States. So wouldn't you be hiking?
Well, but you also have the tax cuts expiring. So what if you get that? Well, then you get a reduction in consumer spending. And tariffs, I would say, is a price level shock. Now, that's a problem for consumers, but, it's not going to be consistent inflation. It's going to be a supply side shock in terms of prices. So I think if the taxes expire, if all the tax cuts expire, I think the Fed's cutting much more.
It's such a bomb to hear you speak compared to sort of the shouting match, which is down in D.C. You're sort of talking about numbers and outcomes and trying to take the hysteria out of some of the rhetoric and the screaming match that we hear in other places. So can you strip out the noise from the signal here when it comes to discussions around the deficit? Because that's something that Janet Yellen's going to speak about quite a bit in her speech. Terry Haynes saying that this is a problem because it unintentionally brings attention to the deficit. Does it matter at this point for you?
The deficit per se, not really. We've got enough cash in the front end. We've got demand for all in yields. If you're getting 6% in investment grade corporate, 9% in high yield, that money is coming in. And it's also coming into the treasury market. I think where it becomes an issue is if Fed independence, which I think this is all political posturing. This is like a preview for what's going to happen between now and November, maybe beyond.
Fun.
Where the Fed's going to be under attack and we have to all take a step back and say, can the Fed independence actually get challenged? You need Congress to pass that, filibuster-proof Congress. I'm not even sure everybody's on the same page in either party either. So, I think at that point, people are going to look at the deficit. And then we come to what happens post-election. I would argue fiscal space is a lot less now than 2016. So notice we're talking about, do the tax cuts expire or do they get extended? The ability to get big stimulus, I think, is just much less.
Priya, this was great. It's wonderful to see you. Priya Misra of JP Morgan Asset Management. If I had a list of people on Wall Street who were least excited about the election, Bramo's up there. Believe me, like top 3.
Oh, you think so?
Without a doubt.
I balance her out, though.
Without a doubt.
I bet that a lot of people would join me.
from New York City, I'm sure they would. This is Bloomberg. Stocks are lower, 60 minutes away from the jobs report. Equity futures down by 0.4%. We're down by 0.7 on the Nasdaq. A little bit softer on the Russell. The small caps down 0.1%. Down on the week as well. We're up on the session. In the bond market, we look a little something like this. Big levels, 5%, then all the way back down to the 480s at the front end. Looked at 470 on a 10-year, all the way back down to the 450s. At the long end, on a 10-year, 456.50, down another basis point this morning. Just backed away, Lisa. ECI feels like a lifetime ago, doesn't it?
He didn't even talk about it. I'm talking about Jerome Powell. Why didn't he bring up the fact that ECI came in hotter than expected? This is their key metric, right, for wage inflation. He really did shock the market. I mean, we were just talking to Priya Misra, and we asked her, do you think that you can be more bullish now on bonds than before the press conference? Unabashedly, unreservedly, absolutely.
Absolutely. Plus, have we put a ceiling on a 2-year? Yes, and arguably maybe even on the 10-year. That ceiling, something around 5% for both.
It feels like this is a Fed that wants to prioritize nailing this soft landing more than any kind of concern about a percolating inflationary kind of heft underneath the surface. And to me, that is a shift that the market has taken notice of. I don't know how that really correlates with this idea of a broadening out in the rally and some of the smaller cap stocks getting bid and all of these things, because wouldn't that imply more weakness under the hood than we're currently seeing?
I do understand there's a lot of contradictions out there, Lisa. There really are. And we could talk about what's happening with corporate America. We've talked briefly about consumer confidence. It's worth going through the details of that. The conference boards, Dana Peterson saying confidence retreated further in April, reaching its lowest level since July 22. Consumers became less positive about the current labour market situation, more concerned about future business conditions, job availability and income. That doesn't scream boom. And that's a word that's been used a lot around here.
And a lot of the earnings and the earnings calls do not scream boom. And we've been hearing about that quite a bit. So how much do you lean into those anecdotes or those qualitative data points, as some people might say, versus just take these headline numbers that show a very robust market?
I love economists. They're not anecdotes, are they? It's real data.
I've actually had extensive conversations about this.
That's why I'm bringing it up.
Yeah.
It's real data.
Well, I mean, in a sense, if you have a lot of sort of orchestrated conversations and you can kind of put them into an Excel spreadsheet and then map them out.
I get it.
It's data.
It's real data. 8:31 in Tokyo. Let's check out dollar yen for you. Going to keep giving time updates on Japan. Dollar yen 153.17. We're down a third of 1%. Look, we did this around the Federal Reserve meeting. What happened straight after the news conference?
Yeah.
Japan gets in the market.
Yeah, and Chris Ansey over on the Bloomberg News side points out that it's also a holiday in Japan. So if you want to intervene, well, it's a great time because it's also a really quiet time, so you can actually have more bang for your buck. So watch out for some excitement in this space.
A week of yen strength against the US dollar. Under surveillance this morning, just under an hour away from the US jobs report, the median estimate in our survey calling for a print of 240K. Bank of America's Michael Hartnett warning a weak print could be a stagflation signal, raising risks of a sell-off in stocks. Let's quote Michael Hartnett directly. Payrolls that come in south of 125 and average hourly earnings north of 0.4%. Stagflation trades continue winning. That's the mix he's looking for.
And then he says if it's 225 or higher and average hourly earnings by less than 0.2%, it would be interpreted as, quote, Goldilocks back on and risk back on. So basically, he's putting these markers in the sand of where potentially you'll hear a lot more people coming out and having whispers of stagflation, or maybe there'll be screams if you get sub 125, or if it's going to be the Goldilocks soft landing, we're off to the moon.
He banned that word on Wednesday, stagflation.
There's no stag, there's no inflation. I lived through the 70s. Cut it out.
You sound like TK, not Chairman Powell.
Well, he banned two words, stag and inflation.
Well, look, I think that he can say whatever he wants, but I think that the market is concerned that there is a toxic recipe that's going to call their hand on some level, with the emphasis purely on keeping a sort of soft landing concept afloat if inflation remains hotter.
Much more on payrolls in just a moment. Let's turn to Apple. Big mover in the pre-market. Shares of Apple rising by something like 5 to 6% through most of this morning. The company announcing the biggest stock buyback in history. Apple also posting better than expected results in China. Wedbush's Dan Ives saying, quote, the worst is now behind Apple in China. I think that's the question we're all asking, not just for that geography, but for the broader sales growth story. There hasn't been much over the last 12 months. Is that run over?
I want to understand the why behind some of these comments from Tim Cook and from the CFO, the team at Apple, because if there is a material shift in China's stance toward Apple, because they want to reach out more to American and international companies, that's very interesting. Which companies pass the bar to be sort of bellwethers for the rest of the industry that can try to support the economy? Or is this basically a head fake as they do something else? I mean, we don't have a real understanding of where the growth is going to come from and why.
That's Apple. Let's keep it on tech. Let's turn to Meta. Hit with a rare underperform rating from BNP Paribas. Stefan Slawinski initiating coverage with a 360 price target and saying this: Meta has no new revenue streams to replenish its resources, which will also continue to be drained by its metaverse adventures. We prefer Gen AI peers with a clearer path to monetization, including Alphabet, Microsoft, Salesforce, and Oracle. Stefan is with us right now. Stefan, let's get straight into that. What is it about the path to monetization that you don't believe in over at Meta?
Yeah, hi, Jonathan, and good morning. Thanks for having me on. And so there really are three concerns here for us. One is just they're going to have to spend more to get there on Gen AI. So companies guiding for CapEx to be up 40% this year. Consensus doesn't have much growth from there out to 2026. So we fear that the CapEx will be higher than expected. The second thing is they're not really freeing up investment by cutting elsewhere. We did have the year of efficiency, but what we're seeing from other peers, whether it's Apple cutting the EV business, whether it's Microsoft scaling back Microsoft Surface hardware sales, they're all carving out areas to free up investment for Gen AI. With Meta, we're seeing the opposite, right? They're guiding for Reality Labs losses to accelerate from here. And then the third thing, as you mentioned, is on the monetization. We're already seeing Microsoft, $4 billion of revenues from Azure. We think maybe $10 billion next year from Azure and Copilots combined. Amazon, multi-billion dollars. Google, workspace subscriptions. Google Cloud enterprise services. Gen AI search monetization. But for Meta, as we point out, the revenues are still coming from Facebook and from Instagram. Yes, there are monetization opportunities in WhatsApp, and that is exciting. But again, it's a very, very early days, and that's going to take some time.
Stefan, I'm reading the note. Achieving victory will require massive CapEx, and Meta's war chest built through its year of efficiency may be depleted. Would you change your view in any way, shape or form if they backed away further from the metaverse stuff?
Of course, we'd have to reevaluate, but that's certainly part of our thesis, which is, as I mentioned, those investments look to be accelerating from here. So, ironically, when you look at Google, for example, they have the other bets business, which they get a lot of grief about, but actually losses there are declining. They're down about 10% over the last 12 months, down to about $1 billion a quarter. For Reality Labs, it's going in the opposite direction. So you now have about $4 billion of quarterly losses on average over the last 4 quarters, and that's likely to accelerate. But certainly, if they remove those, 15, 20 billion of losses, that changes the cash flow outlook for the company.
Stefan, Meta has 63 buys, 7 holds, and 3 sell ratings. You among those 3 sell ratings. How difficult is it as an analyst to put a sell rating on a company that a lot of people have a lot of love for?
Yeah, thanks, Lisa, for asking that question, because it's not easy, to be honest. We aren't underperformed, so I think that's important to say. I think for all of these companies, they are great companies, and Meta is another great company. But as you just discussed with Apple, as we've seen with other tech stocks, there are times to own them, times not to own them. And for some of these companies that go through massive investment phases, thinking specifically of Amazon and Meta, typically you haven't wanted to own them during those periods of investment. And you have wanted to own them during those periods of harvesting. We've seen that with Meta over the last couple of years. The stock's up 400%. Obviously, we've seen that with Amazon as well. It now looks like both companies, to a certain extent, are moving back into that investment phase. And the market right now thinks that's okay. They've learned from the past. It's different this time. They're going to thread that needle and sort of manage the efficiency side of the equation, as well as driving those investments for future growth.
Stefan, there's a sort of theme that people have been talking about where spending can be good. A CapEx spending boom can be the appropriate thing to do if it's on the right types of operations. Are you pushing back on that and saying, just in general, during investment cycles, they're not going to have the cash to give it back to you, so probably going to underperform?
I would say a bit of both. Absolutely investing is good. And I think the Gen AI investments, the AI investments are good. We're seeing those core AI investments already paying off for Meta through improved recommendation engines and content for users, through ad targeting and measurement for advertisers. And I think Gen AI is the right way to go in terms of investments. But again, the monetization mechanism is not very clear just yet. It will take more time. I think on Reality Labs, what the market would like to see is the company say, we still believe in it, but we think it will take more time to play out than we originally anticipated. So we're going to, move some of that spending more over towards AI, and that's where we have some of the concerns near term.
Well, you prefer Gen AI then. What company do you think is doing it well if you don't like Meta?
Yeah, and again, it's not a question of not liking Meta. It's just thinking that, they have further to spend to catch up, right? When you look at the proprietary silicon that they're now developing for model training and inference, this is something Google's been doing for 7 years with their TPUs. It's something that AWS has been doing for years as well. Amazon will have their Trainium 2 chip available in the second half of this year, which is probably going to be driving more consumption of Amazon Web Services platform. So, there is more investment to come here. And when you look at Google, for example, it's actually trading at a discount to Meta right now on an EV to EBIT basis. One of the reasons these stocks have traded on discounts is because they've been perceived to be kind of one-trick ponies, just advertising. But we're seeing with Google already 25% of sales from subscriptions, from consumption, 100 million subscribers for YouTube premium services, 100 million subscribers for Google One, 8 million subscribers for YouTube TV. Obviously, a Google Cloud business, which is really now gaining recognition with enterprises, still trading on a discount. We think as they continue to diversify their revenue streams, they'll see the valuation with Meta flip. So we think Meta could go up to a 5% free cash flow yield, with Google falling to a 4% free cash flow yield.
Stefan, just to wrap things up, it is Payrolls Friday. We're looking ahead to this number and trying to get a read on the US consumer as well. Most of the major companies in your coverage have reported earnings. I just want to understand from your perspective what state this economy is in right now, whether you can strip out the more secular structural growth themes and focus on the cycle for a moment. What kind of strength do you see?
Yeah, so we just published yesterday our BNP Paribas Global Cloud Scanner survey of 100 software buyers. And the way we characterize it is things are rolling along the bottom. So things aren't getting worse. They're not really getting better in terms of enterprise technology spend. Slightly better in the US and slightly better with large enterprise, slightly more cautious in Europe and slightly more cautious with small businesses. On the consumer front, it's okay. It's not great, right? I mean, Amazon said the same thing last week. We did just upgrade Shopify yesterday. We think their results will be good next week, good enough to see some revenue growth acceleration. But to your point, a lot of these secular growth trends continue to power through. What's exciting with some of these big tech companies is it's not about Gen AI yet. The numbers they're delivering today are from the core businesses, which remain quite healthy. Gen AI is still to come, and those valuations still seem reasonable, considering they're not yet factoring in a lot of that contribution that's still to come.
Stefan, this was great. Let's do it again soon. Stefan Stawinski there of BNP Paribas. The latest on Meta, a rare underperform, a rare sell on that stock.
I liked your question there about what have we learned. And he said, we're rolling along the bottom.
Yeah.
That indicates a very different picture than a lot of what we're hearing in terms of optimism and boom times and late cycle. Rolling along the bottom would indicate more of an early cycle, right? Because essentially you only have up to go. That's a very interesting take.
Meta right now, negative by about 0.25%. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A second Boeing whistleblower has died. A former quality auditor at a Boeing supplier, Spirit Aerosystems, died just 2 weeks after developing breathing problems, that according to the Seattle Times. The employee had raised concerns about the safety of the 737 jet. In March, another Boeing whistleblower reportedly died from a self-inflicted wound. Now, the drama is still continuing in the bid for Paramount Global. This time, it's Apollo and Sony making an offer, $26 billion, all cash. Sources tell us it's described as a non-binding expression of interest. Now, Paramount has been in exclusive talks with David Ellison-owned Skydance Media, but a number of shareholders protested that offer, saying it gave controlling shareholder Sherry Redstone a sweetheart deal. That period of exclusivity is scheduled to end today. Ferrari is using this weekend's Miami Grand Prix as an opportunity to unveil a new sports car. It boasts a top speed of more than 200 miles per hour. The 12 Cilindri will cost more than $400,000, and it's inspired by Ferrari's touring cars of the 60s. Deliveries will begin by the end of this year. And John, if I may, if they want a viral marketing moment, just have Lewis Hamilton show up in that thing this weekend. That's
Beautiful.
Your brief.
I'm not sure he can do it yet.
I don't think so.
When he can, those things are going to sell. Danny, thank you. We accept gifts. We don't accept gifts, I'm told. Okay, we don't accept gifts. Just in case anyone was interested, sending me one.
Oh, really?
So, yeah, you know.
You would just sort of be like,
just a cheeky 400k, Bramo. What's that between friends?
They could send it for a quick test drive, but then you have to give it back.
Sort of a test drive, a permanent test drive.
Yeah, I was about to say a test drive.
An open-ended test drive.
The test drive.
An open-ended test drive. We accept gifts. We don't.
We don't.
Up next, counting down to the payrolls report.
If you were to see a big move lower in terms of the payrolls, then that would really shift, I think, the overall thinking in the jobs market and potential summer rate cut back in play.
You don't think they'd allow just sort of a Ferrari, just a sort of cheeky Ferrari, just as an exception to the rule?
I suspect that you're going to get a little toy Ferrari car.
I used to love those as a kid.
Well, you might get one.
Okay, looking forward to the Grand Prix this weekend. We accept tickets. No,
we don't.
We don't. All right.
Stop.
The Federal Reserve countdown is behind us. The payrolls countdown continues. 45 minutes away. The number, 240k. Just to reiterate, we do not accept gifts, okay? We cleared that up. All right, good.
We may not have gotten in trouble.
Trouble with management over something like that. Come on, jokes. Going into the weekend.
Maybe.
Get a grip. Equity futures right now on the S&P, positive by a third of 1%. Yield to low by 2 basis points on a 10-year, 455.89. In the FX market, 107.46. I sense I didn't make that better. Under surveillance this morning, counting down to the payrolls report.
It's been hard to say that the jobs market really is weakening. And so I think if you were to see a big move lower in terms of the payrolls, then that would really shift, I think, the overall thinking in the jobs market and potentially keep it where, or at least put a potential summer rate cut back in play. But it'd take more than just a weak April number.
It's the latest this morning, less than 1 hour away from the April payrolls report. Sarah Wolf and the team at Morgan Stanley expecting a gain of 250,000 jobs. In consensus with Wells Fargo, JP Morgan and Bank of America, Sarah's saying, quote, "We expect continued strength in April. The pace slows slightly from recent months. Our forecast is likely consistent with marginal slacking in the labour market." Sarah's with us around the table. Sarah, good morning to you.
Good morning.
This from the team over at Citi, sensitive to the downside. I wonder if you agree with this line. After Powell took hikes off the table at this week's FOMC meeting, downside risk to yields are magnified by downside risk in today's jobs report. Are we sensitive to the downside this morning?
I do agree with that. I think Chair Powell has been basically dismissing stronger job gains because we don't really know how many jobs we could be adding to the economy without it being inflationary. So there is more sensitivity to downside. And when Chair Powell laid out the two paths for policy, it's higher for longer or cuts. And what could drive more aggressive cuts is a faster deterioration in the labor market. So the onus is on the labor market for more cuts.
What's the source of that downside, do you believe? Based on all the information we have in front of us right now, what could the possible source of downside today be?
It's really hard to see meaningful deterioration. One of the things that we saw that drove upside in the first quarter was some of the warmer weather. So we got stronger construction jobs. We got stronger retail, which is a little bit of a big question because retail sales have not been very strong. So we could get quite a bit of payback there, and that could shave off about 50,000 together if we get some more downside on those two components.
How do you understand the rhetoric that we hear from companies, which is a lot less optimistic, a lot less rosy than what we're hearing from some of these headline numbers or inferring? How do you understand that discrepancy?
I think we're seeing pockets of the consumer that are deteriorating quite a bit in where they're spending, but the overall picture is still healthy. So what do I mean by that? Households are spending on services and not goods. We've been saying for a while that goods were going to be very weak, and that's retail. That's mostly captured in the companies in the stock market, whereas for the broader economy, we're a services economy. Almost 70% of consumer spending is on services. And so now we're seeing that both price and unit growth is under a lot of pressure for retail. People don't want to be spending on everything anymore. Interest rates are high. Lending standards are very tight. The other thing is the lower income consumer, which we've been saying has been basically in a recession for over a year now. And we're seeing that come through in the company data where, for example, in the leisure space that, economy to mid-scale hotels are not doing as well, that for grocers, that people are now not dining out at McDonald's anymore and they're going back to grocery shopping. And so I think there's pockets that are doing better and others that are doing worse. But if you look at services spending in the first quarter, it was up 4% on the quarter. Extraordinarily strong.
So I'm listening to you and I'm trying to understand whether we can really bank on sort of the high-end consumer supporting the overall economy while there's essentially a recession at lower-end consumers. And then it can kind of come together. And this is kind of the bottom right? I mean, that's sort of what we were just hearing from an analyst who covers the tech space. Is that how you see it, that we're kind of rolling along the bottom here with these sort of shifting sands, and we're going to come out the other side on an upswing?
So I think we are rolling through the bottom. The upside is going to come with the cuts, right? And when the cuts happen and how much they happen, because that's going to start to ease up the credit market. That's going to allow lower middle income households to start spending a bit more. It's also going to allow for more churn in the housing market. So more people are buying and selling homes. They're going to be spending more on their home. That stimulates the economy significantly. But the higher income household, the top 20% income distribution, they drive 40% of consumer spending. They really run the economy in a lot of ways. And so if they want to keep spending, maybe it's not on goods, but if they continue to spend at a solid pace, that is enough for us to chug along without a recession.
If the data doesn't come in time to give Powell the confidence enough to cut, but you say the lower end consumer is already in a recession, how much damage is it to this economy and to those individuals if this is prolonged?
It's tricky, right? Because Powell has to react on the aggregate data. So overall GDP numbers are strong, overall payrolls are strong, but the lower end consumer has been under a lot of pressure for a lot of reasons, right? We've been talking about why the aggregate consumer was going to fare better in this hiking cycle than in previous ones. And the biggest one, fixed rate debt. 90% of household debt is locked in at a fixed rate. That is not the reality if you are not a homeowner, where half of their debt is revolving rate. The other one is that if you look at almost like the household NIM, it's better in this cycle than in previous cycles because of the big savings buffer that households built up. So that ratio of debt to savings is a lot lower, but it's for the households that saved. Also, as we know, the middle higher income households, they are sitting on a lot of savings. And so Powell's in a conundrum, right, where the best thing that he could do is keep a strong labor market so that real wages go up, because that's really what matters the most for the lowest income household. And we are seeing that. I mean, we have a long way to go on real wage levels for low income households, but we're on the recovery.
Let's talk about the labor market and the upswing we've seen in immigration. How do you think about this?
Sure. So, I mean, immigration basically just means the economy is bigger, near-term potential labor force growth is stronger, near-term potential GDP is stronger as well. We've estimated that break-even payrolls, the amount of jobs that you could add to the economy without it moving the unemployment rate, 265,000. Because of how strong immigration growth is. I mean, it's massively high. What does that mean? It means that if we get a one handle on payrolls, we should start to think that that's actually possibly a weak print, which is crazy when we used to think break-evens were 100 to 150,000.
Is this getting harder and harder to understand?
It's always getting harder, yeah.
Post-pandemic, we're just seeing these massive numbers. And I remember the estimates, I'd say the low is like 200K, 150, and the high was like 500. It was literally like throwing darts with a blindfold on. And I just wonder what it is now. How easy is it to understand what's happening in this economy?
It's tricky, right? Because the immigration flows were happening last year, but we didn't really figure out that it happened until 2 months ago when the CBO came out with these estimates. So we'd basically been reading the economy wrong in 2023, and now we have a better sense. The thing that I worry about is while we are getting a lot of immigration growth and it is helping support jobs and overall GDP, what about skill frictions, geographical frictions? There's not every industry is hiring. Typically, you see immigrants work in agriculture, they work in construction. Those are not the hot industries right now. We're really seeing more hiring in food services and leisure and hospitality. So you really need to make sure that where the labor supply is coming matches the labor demand. And that's going to be the big question for how high the unemployment rate goes this year.
How fragile is the sort of parameters that you laid out of a soft landing? How fragile is this idea that the high-end consumer can keep spending even as a low-income consumer is kind of flat on their back?
At this point, it's very hard for me to see, given everything we know, a hard landing scenario playing out anytime soon. I think the hard landing scenario could come maybe in 2025 if the Fed has kept rates too high for too long and they react too late. And what can come with that if core services are stickier, if we start to see new rents start to reaccelerate and that starts to worry the Fed, and then you get to a scenario where they've just waited too long. And Chair Powell said it himself, the lags are longer than they thought. So we might be getting a big impact later this year and into 2025. And so there's still this risk management approach where, the FOMC does have to cut to stimulate the economy at some point. I think where we are right now, the recession risks are still fairly low, though.
Things are complex. They always are, but they are super complex right now. Sarah Wolf of Morgan Stanley. The team at Morgan Stanley looking for 250 at 8:30 Eastern Time. The median estimate in our survey, 240,000. Coming up shortly, Nadia Lovell of UBS, former Fed Governor Randy Krosner, Jeff Rosenberg of BlackRock, and the brilliant Mohammed Al-Erin of Queen's College, Cambridge. That is your third hour of Bloomberg Surveillance. Bramo just around the corner.
Yeah, well, this is the reason why I don't believe in midlife crises. They're rolling crises. They're rolling recessions. It's similar.
Who's this a message to today?
It's just general.
Okay, all right. From New York, this is Bloomberg.
Right now, I think the labor market's holding up fairly well. You're going to see the labor market showing us an easing of tightness.
We need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market.
The labor market is also getting into better balance in terms of supply and demand.
We can't continue to see 300,000-400,000 jobs. I think we need to see a little bit of a stabilization.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Payrolls Friday, and the Payrolls report is 30 minutes away. The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Your lineup for the next 60 minutes, this is what it looks like. We'll catch up with Nadia Lovell of UBS, the former Fed governor, Randy Krosner, Jeff Rosenberg of BlackRock, Mohammed Al-Erin of Queen's College, Cambridge. Those four in the next 60 minutes, looking for 240K. That median estimate, according to our colleague Chris Dancy, the highest median forecast before payrolls. Lisa, going all the way back to September 2022.
You asked it to Sarah House of Wells Fargo, and she said you kind of have to add in an extra 25K just to sort of get up to speed, which just shows how little everyone understands this labor market that has been buffeted by a whole bunch of different trends.
Listen to these numbers. AMH, 3-month average, 276. The estimate today, 240. Jefferies, 280. Goldman, 275. A whole group around 250.
And what did we just hear from Sarah Wolf? 265,000 per month is the break even going into this payroll report, even though they're expecting a little bit under that. So you can just see how robust this labor market is, which is why everyone is looking at wages. Because if you want to look at what's going on in inflation, you need to see if the strong supply in the labor market, Jay Powell said it this week. He said they continue to see a strong pace of immigration. Is that putting a lid potentially on wages?
Let's go with Citi, 215, their estimate. Their work this morning from Andrew Honhorst and the team. Downside risks, sensitive to the downside. Lisa, after Powell took hikes off the table at this week's FOMC meeting, downside risk to yields are magnified by downside risks in today's jobs report. Asymmetry, I think, is the word of the last couple of days.
And this is something that Andrew Hollenhorst has sort of been on the peripheries with, at least in terms of saying it out loud. But there are a lot of people in the market that seem to be agreeing, because what you can see is an increasing bringing forward of rate cuts. I understand you said, yeah, they're bringing it forward to November, which doesn't seem either feasible or like it's that soon. However, it does highlight how much this did change things in terms of people's understanding of the Fed's reaction function and what it would take for them to actually come in with cuts.
Think how much things have changed. You start the year, 7 cuts priced into the market, all the way down close to a single cut before the Fed Reserve meeting this week. It can swing the other way with ease, dependent on the data in the next couple of months. Where I struggle at the moment, the consensus position on Wall Street is that you can't get cuts in September. Don't understand it. We had QE3 back in September 2012. If the data's there and they've led us up to that position through the summer, why can't they cut in September if they need to?
To push that a little bit further, if we do see that weakness that justifies a cut and it's enough to actually cause some sort of pivot or turn, there is a concern.
Pivot on a pivot.
I know, let's just move on. But if it does do that, wouldn't that be negative for risk assets? Because essentially, wouldn't that be highlighting a weakness that everybody just shrugs off and says, oh, it's just a pocket here, a pocket there, but it all come together in a good way?
This conversation could change in either direction at 8:30 Eastern Time. That data, 25 minutes away. Equity futures right now on the S&P, the scores look like this. We're positive by about 0.4% through Thursday, just about down on the week, just on the margin on the S&P 500. Yields have been lower through most of the week. I said it early this morning. ECI, the Employment Cost Index, which came in with an upside surprise and took yields higher, 5% on 2s, 470 on 10s. That data point, Lisa, feels like a lifetime ago.
Especially because Jay Powell didn't really address it, but it raises this question, can they really cut unless there's weakness, right? I mean, basically people are discounting that. Again, are we cutting for the right reason, right? I mean, I go back to these narratives and I understand, we were told at the top of the show that that was silly to do. However, it is hard to understand from a theoretical standpoint and framing what's going on right now.
The jobs report just around the corner. Let's start with our top story. It is 25 minutes away. We're looking for 240K. Nadia Lovell of UBS saying this: rate cuts are just delayed, not cancelled. And the Fed put is alive, which should help support equities. We recognise equities could stay choppy near term, partially due to positioning and technical factors, but we believe the market's broader uptrend will persist. Nadia's with us around the table. Nadia, let's start with that Fed put. Why is it alive and well?
You know, Chairman Powell made it clear this week by removing that tail risk and saying that it's unlikely that the next step is going to be a rate hike. And so that should provide a floor to the market. He's also pointing to the employment numbers. Any signs of weakness in the job numbers will cause the Fed to move forward and reduce monetary policy and begin the cutting campaign. We think that, you know, the Fed will likely start to cut in September, not because the economic environment is weak, but more so that we think that inflation will start to back again on that disinflationary trend and get back towards a 2% target next year.
Lots of bond strategists come on the program and tell us how bonds would respond to any given number. They're basically telling us that the bond market would be more sensitive to a downside surprise than they would be to an upside surprise, because they believe that after Chairman Powell's re-established the reaction function of the Federal Reserve, it puts a lid on yields. What would it mean for equities? Does it mean the same thing? Are we more responsive to downside surprises than upside surprises? Or is it just good news is good news and bad news is good news? How does this work?
I think at this point is, you know, good news is good news and bad news is good news to a point. Because at the end of the day, what matters for equity is the growth backdrop. We don't want that to deteriorate too much. And so if economic growth can still continue to hold in there, then that should be enough to sustain the equity markets. And the earnings season itself has been quite positive. And so we think that that will help the market start to resume its upward trend in coming weeks. And then, you know, you have buybacks that's coming back to the market, too.
The level of confusion and lack of conviction really is sort of shocking to me, because we're all at this point where we can't really figure out where to place things, and neither can the Fed. And they've basically been pretty vocal about that. How much does that contribute to your expectation of a great degree of huge price swings on some data point? How do you sort of prepare yourself for a level of volatility that we haven't yet seen, but we on the broad market sphere, but we see in individual stocks where you get, you know, $2 trillion companies that are swinging 13% in a couple hours?
Yes, you know, so we really think that the market is likely to remain choppy here. You know, the market is also looking for some clarity around inflation a bit. We could get that in the next couple of weeks when we get PCE. We want to see how much of that first quarter hotness in CPE was due to seasonal factors or catch-ups and so forth. So you sort of need some clarity on that. And as I noted earlier, you know, we will be past the blackout period for buybacks. I mean, overnight we saw, you know, huge announcement in terms of buyback. I mean, so large that, you know, when you think about it, it's more than the market cap of 80% of the S&P 500. And corporates are a big part of this story. We also think that, you know, it typically happens that investors take a few weeks after the earnings season to just absorb all the information, Lisa, and digest it and analyze it. We think that that will happen. And once they look through the earnings season and see that, you know, we have corporate earnings that are growing at double-digit rates, and that will encourage people to step in and buy this market.
With respect to the buybacks, how much do you follow them? How much is this basically a market that you cannot understand the macro? So just put it aside. Take a look at whether you're buying back the size of Ford and GM combined, plus another couple companies. How much do you just say, well, that looks pretty good. We were going to go for value. Let's just follow that.
It is important in terms of providing a floor to some of these stocks. I mean, reality is corporates are a big buyer, but it's, you know, we just don't focus just only on buyback. It's an incremental positive, but overall, what's at the end of the day, what's going to happen is what's happening with corporate earnings. And finally, this earnings season, you know, we're seeing the rest of the market, that 493, they're growing again, Lisa, for the first time in over a year. And we expect that to broaden out as we get to the rest of the year. You know, and particularly outside of tech, which we continue to like, we are super excited about industrials. We've been talking to clients a lot about looking at AI through an industrial lens and all the spending that's happening for data centers, tremendous amount of spending. These companies are at the forefront, at the epicenter, really, of the data center build out.
So Chris Verone, actually, he mentioned this, and he said, okay, no, this is silly. If you want to own AI, own AI. Utilities, own utilities because of utilities. You don't agree?
That is different. I'm talking about industrial. Utilities, yes, utilities are catching a bit from the AI trade, you know, helping them to overcome the headwinds of higher rates. Usually you don't see utilities moving up in a higher rates environment, but the industrials companies, you think that there is, you know, a bottleneck around getting an AI GPU chip, you know. Guess what? When I talk to our industrials analyst, he tells me there is a huge bottleneck around large transformers. Those are what's needed to be able to download power from the grid to these data centers to be able to cool them. It takes about 2 to 3 years, given the backlog right now, to get one.
Nadia, marry these two stories together, AI and the jobs market, and this print we're waiting for. How much are you seeing in these companies that are starting to use AI actually mean that they can have a little bit less human workers?
Yes, you're seeing improvement in efficiencies. We've heard some companies talk about it, improving efficiency at 80% and so forth. That will have implications for the job market going forward. But as we've seen in past technological changes, it just means that, jobs are shifting. It doesn't necessarily mean it will be detrimental to the job markets. At the end of the day, we all want to be more productive, and use our skills in other ways that adds to productivity to the overall economic environment. So we think that you will see a shift, but it won't be too disruptive to the job market, and it will take some time to get there.
So how do you want to play this broadening out? Where do you go beyond industrials? What are you looking at?
We're also looking at healthcare. Again, some secular trends there. I mean, look at the numbers that we saw this past week in some of the obesity names, And despite that strong demand, constraint is what's holding back growth. Supply constraint. We should have more capacities coming online later in this year, and that should help even boost the top line more for some of these diabetes and obesity companies. And the reality is we're seeing new data from some trials ongoing in some companies that I won't name, but you know what I'm talking about. It's not just the two top companies that are in obesity. You have some potential other players that might be coming in subsequent.
Not just
periods.
Novo and Lilly. I can say that for you. Nadia Lovell of UBS. Nadia, thank you. You're one of the best. Appreciate it. Buybacks. Listen to this for a number. I was speaking to Robert Schiffman of Bloomberg Intelligence last night. He's one of the best. You should reach out to him. Apple has rewarded shareholders with more than $839 billion since 2012. And that number after yesterday is higher.
It's a shocking amount. I mean, what did Nadia just say? It's actually bigger than 80% of the market capitalization at the S&P 500. At this point, how do you view this company, though? I keep going back to this. Is this a growth stock, or are you just counting on them just to...
That $110 billion, I think, is the equivalent of, say, a Boeing or a Lockheed Martin. So think about how large those companies are.
Yeah.
Pretty amazing.
Quickly, almost both of them combined, depending on how things go.
Yeah, for one of them in particular. We hope that gets better, I think, for all of us, right?
Yeah, for all of us.
I think we all need Boeing to get better. Equity futures right now on the S&P, positive by 1/3%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Probably worth checking on Apple, given that huge buyback is up 6%. Of course, it wasn't just the buyback. It also defied some of the worst of the gloom. But let's be honest, also raised questions on its China sales versus weaker showing third-party channel checks. So that $110 billion, you already went over how big it was. To be fair, it topped $100 billion, which was the prior record, which was also Apple. Dan Ives of Wedbush, long an Apple bull, wrote that betting against Cook and Cupertino in an AI-driven super cycle and a $110 billion buyback is the wrong move for investors. Shares of Coinbase, on the other hand, sliding down more than 4.5%, even though it had a first quarter beat. Its trading volume and app downloads had surged when spot Bitcoin ETFs were launched in January. But Mizuho analysts point out that all of that was largely to be expected with the record run up in Bitcoin. On the other hand, there's potential regulation, signs of dropping transaction revenue that overshadowed the beat. Now, I think I might have one of those companies that Nadia mentioned but didn't name. It's Amgen. Those shares are surging in the pre-market thanks to their push into obesity drugs. The CEO said he was very encouraged by a trial of their experimental obesity drug. Now, if approved, Amgen said that patients would use a handheld auto-injector just once a month or even less frequent single injections. Now, that compares to Wegovy and Ozempic, injections you need to take once weekly. And that potential competition has sent Novo shares down nearly 4% this morning. That's your Bloomberg Brief. John.
Danny, she won't confirm or deny. Won't confirm or deny. Danny, appreciate it. Thank you. What do we say about payrolls? The most important since the last and until the next one.
Yeah, basically every time. I love how analysts come on the show and they're saying, yeah, it's one number. You need a number of numbers. And then some of the commentary on the street. Going to be wild, except huge balls. So that's some of the, the dissonance here.
That should be the promo for the next 15, 20 minutes or so. It is going to be wild at 8:30 Eastern Time. Up next, the jobs report just around the corner.
The unemployment rate's been below 4% now for 2 years. Again, as the process of normalization continues, it's hard to get worried about how it's all evolving.
Live from New York City this morning. Good morning. Here are the scores on the board on the S&P 500 going into this jobs report. Equities are positive by 0.4%. Yields are a little bit lower. We're down 2 or 3 basis points, 4.5527. How different that bond board, that screen looks, Lisa, compared to where we were after the employment cost index earlier this week.
When people were still talking about rate hikes, and we heard Jay Powell talking about the potential for no cuts or a lot of cuts, but not the other thing. So it seems like right now, people are just wondering, okay, how quickly can we cut rates, and will this report confirm that?
The 2-year was at 5%. It's now at 4.86. The 10-year was looking at 4.70. It's now at 4.55. Under surveillance this morning, the jobs report just around the corner.
It's hard to get too nervous about the health or the state of the labor market. It looks like we're still really looking healthy. That foundation for the economy is solid. I think that we need to draw a huge distinction between renormalizing of the labor market and weakness in the labor market. The unemployment rate's been below 4% now for 2 years. Again, as the process of normalization continues, it's hard to get worried about how it's all evolving.
So here's the latest. The April payrolls report just moments away. The median estimate in our survey here at Bloomberg calling for 240,000 jobs. Former Fed Governor Randy Kroszner joins us now to discuss. Randy, great to catch up with you, sir. Last time we spoke ahead of this number, you said the focus should be on wages. Is that still the case?
I think definitely still the case. I think you can really see from Jay Powell's remarks, he's laser focused on what the labor market means for inflation. And the productivity numbers came out not quite as strong as they had been from before. If the productivity numbers aren't strong, that means that it's very hard to have continued 4% wage growth and the inflation rate getting down to 2%.
Randy, with that in mind, how strong is the relationship between headline payrolls growth and wage growth?
And so there's a reasonable relation, but not a perfect relationship, because a lot of it has to do with expectations. Where do people think inflation is going to go? And also making up for lost time over the last couple of years, where inflation was much higher than wage growth. And people are still saying, hey, I need to catch up because it's so expensive for me to just put food on the table for my household.
Randy, are you surprised that in light of that, Jay Powell didn't talk at all about ECI?
Well, I don't think he wants to emphasize one particular number too much, but certainly that is one of the things that they are thinking about, because the most important input price in the entire economy is the wage.
Well, do you think that this is actually a legitimate reason to take rate hikes off the table? I mean, basically, that's one key question. Why do you have confidence to take that sort of potential risk out of the market's expectations in light of data points that have shown hot wage inflation?
So he's hoping that it's not going to be an uptick. That certainly we've seen the inflation rate kind of come down very significantly, but kind of stall. We've talked about this before, the kind of last mile problem of getting down to that 2%. So I think he's thinking that we're still in restrictive territory, but he doesn't want to be too restrictive because he wants the labor market to be as strong as it can be, bringing us down to 2%, that immaculate disinflation, that Goldilocks scenario.
Do you agree with him? And that sort of piggybacks off the conversation we were having with Sarah Wolf of Morgan Stanley, where she said part of the calculus here is that lower income families are pretty much struggling. They're pretty much in recession. And he wants to keep the labor market as strong as possible so at the next leg, they can start to catch up. How much do you think that is behind some of what some people are interpreting as a pretty dovish message from this Federal Reserve?
So I think he wants to keep the labor market strong for all of the different groups, but certainly that is an important focus. When in 2020 they came out with their average inflation targeting approach, they really emphasized trying to keep the labor market running a little bit hotter to help people at the lower end. So I don't think that's been forgotten.
Randy, what do you make of the fact that the Conference Board, it's actually concerns not about inflation so much with U.S. consumers, but actually concerns about wages and potentially their next job?
And so I do think that there are some signs the labor market is starting to slow a little bit. I mean, certainly the number of unemployed workers per job opening, that's changed a bit to make things a little bit less sanguine for the markets. We'll see what happens with this employment report. I think at some point we are going to see the job market slow, and at least anecdotally, I've been getting more and more kind of feedback that we're seeing that not only at the lower end of the market but also at the higher end of the the market.
Randy, do you think that the headline figures are masking true weakness under the hood?
It could be. And so we really need to look into the details of the numbers to see what sectors, what pieces are showing strength and weakness. And so I think things overall look pretty good. And so far, we have had something close to an immaculate disinflation without really any uptick in the unemployment rate and the inflation rate coming down from almost 9% to, depending on how you measure it, 3% or so. That's a pretty good record so far.
How much conviction do you have in the soft landing versus the prospect of a hard landing that we were hearing from the likes of Citigroup's Andrew Hollenhorst, that this weakness is actually going to suddenly materialize at a time when the Fed has not yet cut rates?
So I think, as I think you've heard me say before, not soft landing, not hard landing, hardish landing. So I think at some point you will have to pay the piper. I think at some point you're going to start to see the unemployment rate move up. And part of this is because Fed policy has only become really restrictive relatively recently. If you look at the inflation-adjusted interest rate, that is the real interest rate, it's only become positive over the last 6 months or so. Same thing for wage growth. Real wage growth had been negative and now has become positive only over the last 6 months. That's great for families, but it's going to be less desirable for firms to be hiring people when they've got to pay them 4% more and they only can sell things at 2 or 3% more. So I think, given typical lags of sort of 9 to 18 months, towards the end of this year, you're going to start to see the unemployment rate tick up. And will it be recession? Not necessarily, but I do think you're going to see a slowdown.
Randy, you've been saying this for a while, and I understand the logic. Consumers lose confidence, corporations lose pricing power, and ultimately you reach for that lever that no one wants corporations to reach for. But it happens in cycles. They start to lay people off. There was a feeling that coming out of the pandemic that maybe we'd see a hoarding of labour because of the difficulty that certain corporations had hiring. Where would you look for weakness first, Randy, with that in mind?
So I think I'd look for in different parts of the look at the overall numbers that we'd be seeing now. If you see lower wage inflation, that would start to see that people aren't pushing as much as they were. Also, if you're seeing less quits, which we certainly have seen a bit, people seem to be a little bit less certain about the market. You had the Great Resignation. Everybody was willing to quit because they knew they could move over someplace else and get paid more. We're not seeing as much of that. So I think those are the beginning signs of at least a little less heat in the labor market.
Randy, enjoyed this. Always fantastic. Thank you, sir. Randy Kroschner there, the former Fed governor, breaking it down for you. 6 minutes away from that payrolls report. Mike McKee joins us now. Mike, you'll be breaking down the number. Walk us through what you're focused on this morning.
Well, two things, John. I think the first thing that's going to get everybody's attention is the headline.
I believe we've lost that line, Michael. You back with us? You're back with us, Mike. Carry on, please.
I'm here. Do you? All right. They invented the internet out here, so it doesn't work. We get 240,000 is the economist consensus. That's the highest since September of 22. So economists are betting on a fairly strong number, and the whisper number is 244. So everybody is kind of leaning in the direction of strength. If we don't get that, then that will cause a reaction on Wall Street because people are looking for that slowdown that Jay Powell is talking about. And then, of course, the other thing is always average hourly earnings. Do we see a difference there that suggests that we're seeing wage pressures, because we got that in the ECI last week?
Mike, we apologise for the technical connection. We're going to re-establish things and get that set up for 5 minutes' time when the payrolls number actually drops. Mike McKee, thank you, sir. He'll be catching up with Goolsby a little bit later of Chicago as well, so don't miss that conversation. I think 10:30 Eastern time. Then it's Goolsby and Williams sitting down together this evening, responding to this jobs number. So fantastic lineup of guests right here on Bloomberg, and also the Fed reaction that I'm sure you all want following this number that drops in about 4 minutes' time. The number we're looking for, 240K. That's the estimate, the median estimate in our survey. Mike McKee's going to break it down. Mohammed Al-Arian, Jeff Rosenberg reacting. Your jobs number drops next. The jobs report 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.4%. On the Nasdaq up by 0.6. Switch up the board in the bond market. The 2-year yields lower by 2 basis points, 4.8432. On a 10-year down 3 or 4 basis points, 4.5465. The estimate in our survey, 240k. The number, 175. Mike McKee can break it down. Hey, Mike.
John, we seem to have some good news, at least as far as Wall Street is concerned, thinking that maybe the economy would slow, and 175,000 is certainly slow compared to what we have seen in recent months. Last month, remember, the original was 303,000, and that has come down to 175 this month. I'm looking for the change here, but the unemployment rate goes up a little bit, 3.9%. Change in private payrolls, 167,000, 315. Last month was revised higher to 315, so we have really come down almost half of what we had last time. The unemployment rate, as I mentioned, 3.9%. Average hourly earnings only 0.2%, which is going to be seen as very good news. There's some statistical reasons that a number of economists thought it might be a little bit hotter, which pushes the average hourly earnings on a year-over-year basis below 4%, which may be the first time since the pandemic, 3.9%. Weekly hours, 34.3. That's a tick down from what we had the prior month. And the labor force participation rate is unchanged at 62.7. Manufacturing payrolls up 8,000. There were 0 jobs expected, so manufacturing may be making a little bit of a comeback. But overall, 175, a negative 22,000 for revisions, which all had to come out of probably the March numbers because April revised up. I'll dig into this, and you guys can get the brains to tell us what it all means.
Mike McKee, there is a character from a fairy tale you're going to hear a lot about today. Her name is Goldilocks. This is what it looks like. 175, decent but not too hot. A downside surprise. The estimate was 240. If Wall Street could have made up these numbers itself, Wall Street would have come up with these numbers. 175 on payrolls, wages a little bit softer. Guess what the market's doing? Rallying and rallying hard. We often say the first move is not necessarily the right one, and maybe this doesn't stick, but this certainly makes sense. We're up by 1% on the S&P 500, up by more than 1.3% on the Nasdaq. On a Russell, up by 1.5. If you switch up the board and get to the bond market, we've talked a lot about the asymmetry coming into this number, that this number, if it was lower than expected, would move this market more than if it was higher than expected. It is. Yields are lower by 14 basis points at the front end. Think about this week. We've seen 5% on a 2-year. You're now seeing the low 470s at 473.47. On a 10-year, we had a look at 470 this week. Said it early this morning, twice already. The ECI report, the employment cost index, feels like a lifetime ago. We've gone from 470 down to 446.69 and down 11 basis points on the session. It's a double-digit move across the curve, the 2-year out to the 10-year. And hello, Tokyo, over in Japan. It is about 9:33 p.m. Friday evening, and I can tell you the Ministry of Finance is happier with this one. Dollar yen gapping lower by 0.9% to 152.20. Bramo, I think we call that the right kind of downside surprise.
It's basically everything that the Fed would want and then some. Basically, you have lower than expected wage inflation and a number that's cooler but not too cool. That said, I will just point to the fact that revisions for the prior month were actually revised upward, so it was not necessarily all this sort of Goldilocks type of feel. But to me, the asymmetry point that you've been bringing up absolutely nailed it, which is essentially what we were going to get was a big rally or a bigger rally. And right now, it's the bigger one.
Right now, you've got a big rally. We're up by 2 percentage points on a Russell, up by 1% on the S&P 500. The opening bell a little less than 60 minutes away. If you are just joining us, here are the numbers for you. 175 is the number. The estimate was 240. That's the headline payrolls print. Looking at unemployment, it comes in at 3.9%. Previous number 3.8. The estimate 3.8. And wage growth month over month, 0.2%. The estimate 0.3. To react, here's the lineup. Mohammed Al-Erin of Queen's College, Cambridge, alongside BlackRock's Jeff Rosenberg. Mohammed, first to you, your reaction to this one.
You said it, John. A Goldilocks report that will please the Fed and please the markets. I'm not particularly surprised on the miss on job creation. because we've been running at very high levels for the year and a monthly average of 251,000 before this one. I'm a little bit surprised on the wage, the 0.2. That's the one that surprises me. But overall, it is a Goldilocks report.
Mohammed, at first look, how would you explain that? How would you explain this continued strength in payrolls growth and this little weakness, touch of weakness, softness in wages?
I know how it will be explained. It will be explained by new entrants into the labor force at a much lower level. I'm just surprised it has made that much of an impact. So that's something that one needs to look at much more closely.
Jeff Rosenberg, I'd love your take on this, because right now the market is celebrating. Are you celebrating also? Do you think this is a reason to buy, or do you view this as basically a lot of noise for people who are just looking for any direction at all?
Well, I think Jonathan said it. This couldn't have been scripted better. This report runs the tables for a good report. This is bad news a little bit, is good news, but it's really just about, how bearish we got. Jonathan mentioned it, ECI, the rate moves, the expectations in front of Wednesday's FOMC. So some of this is just positioning. You had a lot of bearishness, so people put shorts on. There was a big momentum to higher rates. But this is a good report across the board for validating what we heard from Jay Powell on Wednesday, that kind of what me worry about inflation. No, things are going to slow. Don't get overexcited. And I think it's a little bit of that overexcitement on the short side that's being wrung out of the markets right now.
Mohammed, does it concern you that we saw the unemployment rate tick up to 3.9%, the sort of incremental shift up about a half a percentage point from some of the recent lows?
Does it concern me? Yes, because people are losing their jobs. But let's not forget, we've had 27 straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No. But if the increase accelerates, that would really worry me. Remember, especially at the low income side, wage are key to consumption and key to economic growth. Pandemic savings have been run down, credit card balances have been run up. So wage income is absolutely critical to the well-being of this economy. So 3.9% is still a really good unemployment rate, but I wouldn't want to see it get close to 4.5% anytime soon.
This softer print, though, that we're seeing and digesting right now, Mohammed, is this enough for potentially people to start talking about cuts this summer?
Oh, I suspect that what was pushed back to December got pushed, I don't know which way we go. Anyway, it got pushed forward to November before this, and after Chair Powell, this will take us to September. There is a bigger issue, and others can speak to it much better than I can, including Jeff, is this volatility that we're seeing in the interest rate structure. It is causing havoc elsewhere in the world when U.S. rates swing as much as they do on a short-term basis. So this volatility, which we are continuing to see in rates, risks breaking something elsewhere. And that's what we got to keep an eye on.
Well, let's get into that. So the next stop for this conversation, for anyone who wants the calendar, May 15th is when we get the CPI report. So this can all change once again, as you all know. Jeff, let's talk about that. How much expectations have swinged? How much the narrative has changed? I remember a conversation we had with Aberdeen, James Athey. He called it narrative table tennis, narrative ping pong, just back and forth, back and forth. We've gone from 7 cuts to 1. Arguably, by the end of today, we'll be talking about 2 again because of this jobs print. Jeff, what do you make of that? Just how quickly we've gone from one direction to the other in rate pricing?
Well, it's because the Fed has abandoned forecast-based monetary policy, right? We basically have had a very bad experience with trying to forecast inflation. So we've abandoned forecasts and we react to the data. And we're reacting to the data because the Fed reacts to the data, and that's basically what they tell us to do. And it's very hard print to know where that data is going. We've had serial degrees of surprises. And we're continuing to see those surprises. And so that's why there's this heightened degree of volatility, because the Fed is basically no longer willing to provide a forecast, to stick with its forecast, to give the market a clear trajectory. And so we're really forced to react and change those expectations for timing, December, November, September, July, based on every single data point.
Mohammed, you've said this a million times. Every time we've spoken on Payrolls Friday, the lack of a strategic anchoring at the Federal Reserve, contributing to this whipsawing that we've seen in rate pricing on every single data point. You've talked about them being hypersensitive to incoming information. In the Financial Times, I saw your recent article. Chair Powell's dovishness is right, not for the reasons that he believes. Can you talk to us a little bit more about that, Mohammed?
Yeah, and I want to thank Jeff. I wanted to reach out and hug him through my computer, because he just said what I've been saying, which is rather than provide a strategic anchor to markets, the Fed got on the roller coaster of reacting to high frequency data. And therefore, we have a very reactive Fed. And what does that do? It amplifies the volatility in the market. So there is a concern that the Fed is overly data dependent. I think that overly data dependent stance is what may end up leading us into a Fed policy mistake. I hope we don't get there. And that's why a strategic view is necessary. And I suspect if you were to take a strategic view, you would not have validated the market's overreaction from going from 7 cuts all the way to 1, where some people even say you're going to get a hike. You would have said, no, this economy is slowing. It's slowing in a gradual fashion. Let's not push it into something more dramatic. And you would stick to your 2 to 3 cuts this year. But this Fed is data dependent, John, so I don't know where they're going to end up.
Jeff, what's your take on that? This idea that the fluctuations in and of themselves, sort of whipsaw action and whipsawed narratives in markets, is actually creating a potential headwind to how this all plays out and potentially to the Fed actually achieving their soft landing?
Well, I mean, it is a headwinds, but we also have to see the other side of this, that the equity market has been, much more resilient to these shifts in the interest rate narrative. And when you think about financial conditions and the transmission of market volatility into the real economy, it's mostly going to happen from the equity side. Not to say that interest rates and credit spreads don't matter, but we're talking about volatility around elevated rates of base rates of borrowing in an environment of very muted and compressed credit spreads. So the marginal financial condition easing and tightening, it's coming from the equity side. And there the story has been much more about the numerator, much more about the secular growers, the tech story, the incredible earnings that we're seeing. And as long as the rate picture stays bounded, unlike what we had over the last 2 years with these huge swings from Fed policy, inflation uncertainty, I think you can mitigate some of that transmission of the volatility that we're talking about as a result of the Fed's policy shift from forecast to data dependence into the real economy, because you're not really seeing it transmitted through the equity market.
But Jeff, do you think that there is sort of a challenge to the broadening out trade? To Mohammed's point, that this actually could cause something to break outside of the United States at a time when a lot of people are saying the U.S. is no longer so exceptional, the rest of the world is catching up. Does this challenge that?
I mean, there are certainly challenges. Jonathan highlighted the yen reaction, the FX component of interest rate divergences. You always have those degrees. I think what we've seen, though, is a remarkable degree of resiliency in the global economy. I think we talked on Wednesday about the differences in emerging market sensitivity to Fed policy this time round. Really much more about a function of the change and the more traditional policy approach happening in emerging market central banks, much more credible policy, dampening some of that pass-through. So I think you have certainly the core interest rate volatility. You look at the MOVE index, it was once at 50, now it's between 100, 150, 200, much higher degree of interest rate volatility. And that has its problems, as Mohammed laid out. I think we're seeing a little bit less pass-through, though, in some of these more traditional areas, and that can kind of mitigate some of this concern about the effect of the policy uncertainty from data dependence into the real economy. Not taking away what Mohammed said, though, I agree with his point that you still have the potential there for a policy mistake as a result of no longer anchoring to forecast-based policy.
Let's reach for dollar yen. Let's talk about that move, not just on the session, but talk about it on the week. It's been phenomenal. Moments ago, we had a 151 handle on dollar yen. Right now, just about holding on to 152 at 152.24. On the week, it's about 4 percentage points of yen strength. But go from the highs of Monday. Monday, 160.17. From those highs to where we are, you've seen a move of more than 5 percentage points. Yen strength Yen strength big time. I've mentioned the time in Tokyo repeatedly. It's 9:44 p.m. going into the weekend in Tokyo. Raise a glass. Sort of, walk away feeling pretty good going into the weekend, Bramo, because that's the stronger Japanese yen the Japanese authorities wanted.
They could either walk away or they could lean in, do a little more intervention now when they're in a holiday and you're actually getting a tailwind from the U.S. economic data. And you want to be short us? You want to be speculative? Good luck.
Mohammed, I don't know if this move sticks, but I'm sure they want it to. How happy do you think authorities are abroad after this number?
So certainly the Japanese authorities are very happy. Between Chair Powell's more dovish than expected press conference and today's number, a lot of the pressure has been relieved. And like you say, we were at 160 on Monday, and we are at 160 risking another disorderly move. I suspect that around the world, people will feel some relief. You have emerging market economies that need to cut interest rates from a domestic side, but are afraid of the consequences for their currency. Yes, Jeff is right. They've been resilient so far, but the degree of resilience has come down a lot. So we shouldn't test them too much. You have the ECB that wants to diverge for good reasons. They wants to diverge from the Fed and keeps on telling us we're not Fed dependent, but knows in the back of its mind that there's a limit. For the rest of the world, it's about the movement in the U.S. Yield curve. It's about what U.S. rates are doing. For the U.S. economy, I agree with Jeff. It's about the equity market. But for the rest of the world, because of exchange rates, it's about what U.S. yields do.
Well, let's sit on the rest of the world, Mohammed, just for a beat. So the conversation's been dominated, as you know, over the last month with words like exceptionalism. You've written about it. Divergence. There will be some people getting excited about the prospect of convergence, that this was peak exceptionalism when we're moving on beyond that maybe we've seen the peak in the US dollar, a peak in US yields. Do you think those conversations this morning, Mohammed, after one jobs print, are a little bit too premature?
Totally too premature. There's three elements to this exceptional U.S. behavior. One is its growth performance. Two is the manner in which it's investing in the future. And three, it's its ability to get away with a fiscal stance that other countries cannot get away with. In order to get convergence, you would need convergence on all three. And we're not going to get convergence on all three. U.S. is going to remain exceptional. Its growth performance may not outpace others as much as it has, but it is the only major economy in the West that is seriously investing in tomorrow's engines of growth. And because of the role of the dollar, it can run an irresponsible fiscal policy for much longer than others can.
They retain the privilege of acting recklessly, maybe for a little bit longer. Lisa, let's be clear. Yes, it's a downside surprise, but these numbers are still pretty exceptional.
Well, that's exactly the reason why people are saying it's Goldilocks, including yourself. You nailed it with the very beginning, because essentially this is not a market that's flat on its back. This is not a labor market that's slowing down or grinding to a halt. It's one that's moderating. That's what people are going to say. And it's one where wage pressures are showing to not be as great as some people feared, which is exactly the recipe that the Federal Reserve was looking for.
Let's put some numbers on that, Bramo. Let's go through things. If you are just joining us, welcome to the programme. The jobs number dropped about 18 minutes ago. 175 was the number, 175,000. The median estimate was 240. The previous number, a lot higher than this, of course. And the previous number sparked a conversation about whether we were running things too hot. Look elsewhere. Unemployment comes in at 3.9%, a little bit higher than the previous read of 3.8 and higher than the median estimate of 3.8. The wage growth figure, average hourly earnings month over month, 0.2%. That is a downside surprise. We were looking for 0.3. Now, the read across is pretty obvious in financial markets. Equities had a look at this and ran away high. Much higher, up by 1 percentage point on the S&P 500, the Nasdaq up by 1.6, the Russell up by 2 full percentage points. You turn to the bond market, this is precisely what we've been talking about throughout the whole of this morning, the potential for a small downside surprise to generate a big move lower in bond yields, and that's what you've got, a double-digit move at the front end, down 10 basis points to 477, down 9 on a 10-year to about 450. We've mentioned foreign exchange already, but as you might expect, the dollar is weaker against the bulk of G10 this morning, all of it. Look at it against the Japanese yen, dollar yen 152.38 on a week that we've had a look at 160, an unbelievable turnaround in that currency pair. Mike McKee, you've had about 20 minutes to go over this one. What jumps out for you?
John, the interesting thing about unemployment, and I'll reassure Mohammed a little bit with this, is that it was a very little move. You have to go out to three digits to see what really happened. Unemployment rose by 3.865%, which rounds up to 3.9. Last month it was 3.829. So we're at about 2/100ths of a percentage point higher in unemployment. 63,000 people were unemployed, according to the household survey. 25,000 additional people were employed, and the difference between the two is that 2/100ths of a percentage point. So it's not a big deal that unemployment went up, and of course the Fed's been looking for that. The other thing that stands out is that it looks like April was a real outlier, because not only was the number revised up there, March was revised significantly lower, and we've seen some changes in the unemployment rates. Remember, last month, black unemployment skyrocketed. Now it comes back down again. It was 6.4. It's down to 5.6, an 8 basis point drop there. So it looks like April was an outlier with its strength, and March brings us sort of back into the pattern where we're starting to slow down. Some other interesting numbers: governments lost jobs, transportation and warehousing gained a lot of jobs, and they'd been losing jobs. Construction was up 9,000, manufacturing 8,000. It's kind of a broad strength in the economy, but at lower levels.
Mike McKee, you're sitting down with Goolsbee a little bit later, about 90 minutes from now, actually. What's the first question after this one?
Well, in the past, Jay Powell has said that they get the numbers in advance when they have a meeting that week. I want to find out if that's true, because that might explain why he was so dovish and why he was so confident that inflation would continue to fall, even though Wall Street was having a bit of a heart attack. That, and then where does he think inflation is going to go and why? That's the big thing. Is it monetary policy that is pushing inflation down, or are we going to see these whack-a-mole one-offs keep popping up?
Mike McKee, looking forward to the conversation. Thank you, sir. Still with us for a final word, Jeff Rosenberg of BlackRock and Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, for a final word to you first. What are you looking for from the Fed speak going into the weekend and into next week?
So first I want to thank Mike for reassuring me, and thank him also for wearing blue after the Mets' big win against Chicago yesterday. Thanks for that, Mike. That's really important. I just would like to hear other Fed officials reiterate what Chair Powell said.
What about you, Jeff? I mean, is that basically your takeaway, too, that basically you just are not going to wait to hear what other Fed officials are going to say? And otherwise, it seems like this is the same place we were before?
Well, I think this is going to, kick off the narrative about long and variable lags to the downside. And what a remarkable shift, bookmarking the week. The beginning of the week was wages accelerating, surprise to the upside, kind of a lot of hawkishness. Now you beat on the downside in terms of AHE and the payroll report. It drives the narrative to the other direction. So there's a lot of short-termism, but this Fed is anchored on a couple of things. That's what I want to hear about. Number one, they're anchored on this concept that it's about long and variable lags. They're worried about those long and variable lags, the policy error that Mohammed talks about. And that creates this asymmetry. And they're worried about that because they believe that this policy is sufficiently restrictive. I don't hear enough about the implication of financial conditions impacting that degree of perceived restrictiveness. And this is going to ease financial conditions. I mean, that's the flip side, is you're running monetary policy with financial conditions in the driver's seat, not interest rates. So sometimes when the market gets ahead of itself, it's too much of a good thing. Wouldn't say that's the conclusion to draw from today, but those impacts, that assessment is what I want to hear from the speaker.
Well, we'll see where these prices close at the end of today. Hey, Jeff, great to catch up. Jeff Rosenberg there of BlackRock, alongside Mohammed Al-Erin of Queen's College, Cambridge. Just some final thoughts around the table. Median estimate was 240. Bramo, we got 175. If you look at the estimates on the street, only 3 economists south of 200K. We talked a lot about this morning, conditioned by upside surprises that everything started to climb a little bit higher on Wall Street, and that was your downside surprise, and they've been rare over the last few years.
I'm not sure what to make of this. I'll be really honest. I think the only thing I can make of this is that this was a market that was coiled to move. And it seems like a lot of people were looking for some kind of big move, and they got one. Whether it sticks is going to be a key question. Whether this changes anything, I don't know. I want to understand the composition issues that went into average hourly earnings to understand exactly where the job gains were and how that might have affected where things came in there.
I know we talk about a lot what this means at the Fed and for Chair Jay Powell, but it's once again below 4% in the unemployment rate for the 28th consecutive month in an election year. But Enda Curran talks about the fact that it's a lagging indicator. Look at the jobs market. Where is this jobs market going to be 6 months' time before the election in November?
I want to do two things. I want to give a shout out to the team at Citi, Andrew Hollenhorst, Veronica Clark, who were looking for a downside potential on jobs growth today. And we're talking about asymmetry repeatedly over the last few days. So shout out to them. At least so far, so good. I want to finish on this, though, Lisa. The swings we've seen in the market this week. We've mentioned this already. The employment cost index feels like a lifetime ago. The numbers we saw on Monday on dollar yen, 160. This morning, a 151 handle. The levels we've seen on yields at the front end, 5%, all the way back down again. At the long end on a 10-year, 470, all the way back down again. This narrative is just swinging from one point to the other repeatedly. We're being so sensitive, to Mohammed's point, to incoming information every single month, every week, every single day.
And how much does that really challenge the broadening out kind of idea if a lot of other countries are depending on the U.S. stability to kind of help them gain some trajectory? But also, is there some sort of tightening effect of the wild swings? Or is it simply just with no consequence because ultimately earnings are and will continue to do what earnings do?
This conversation has been anything but stable so far this year. Let's be clear about that. This conversation will continue on Monday. Here's the lineup for you. Greg Battle of BNP Paribas, BlackRock's Wei Li, Keith Lerner of Truist. We'll catch up with Citi's Veronica Clark. Looking forward to that conversation. Have a wonderful weekend for all of you at home. Equities right now rallying by more than 1% going into that opening bell. 34 minutes away from New York City. This was Bloomberg Surveillance.